welcome everybody. Thank you for coming here for this day. This is kind of an experiment for us in a way, because it's the first time we do such a workshop delivered by me. So we've been doing angel investing and organizing angels for quite a while, but so far we worked with external trainers, but since we've gained already some kind of knowledge and experience, we think we can give you a framework of what angel investing is about, so you can have an idea and you can have some things to work with. So I guess that the audience is a little bit mixed, but we'll get to that in a moment. Please be aware that we might be a little bit okay, not so strict in terms of timing, like, okay, the first session we're going to cover exactly that, and the second we might just mix things, just because we haven't done it, so we don't know which part is longer, which part is not. But at the end of the day, it's about you. You are here to learn something, so please stop me, ask me things, so we can make it as interactive as possible. So this is the content that we are planning for today. The first part, we're thinking of covering the things that happened before the deal, or even before your journey as an angel investor, so you can have a clear understanding about motivation and the right profile, and then what you should do right before the deal, before you take the decision. And then the second part will be about the deal making, okay, the investment process, how to structure a deal, how to write or read a term sheet, so you can have practical knowledge about that when this happens, so you know what to do. At the end of the day, we know that you are not professional investors, so you're not going to be professional investors, or maybe some of you will be, but this knowledge that we are giving to you just to give you some weapons to fight with when you enter this kind of situation. And then after, in the afternoon, we have a session, what happens after the deal, how you can help the companies, what kind of expectation you should have about exits. At the end of the day, we are that type of investor that puts some money and some help in a company, but we expect to sell it, so which is important. If we have time, I want to also give you an understanding about the startup ecosystem, about the venture capital funds that we're here, so you can know who is who, what are the players in the market. But please ask me questions that are of your interest. I have a slide for that. But before I go to it, I probably will tell you a few things about me and our club. So by trade, I would love to say that I'm an entrepreneur. I started kind of 10 or 12 companies. A few of them failed. Some of them I sold. And but this kind of journey led me to a moment where I decided to go on the other side, where I would like to help other entrepreneurs. So first I started by becoming a director of a pre-seed accelerator called the Founders Institute, which is one of the biggest in the world. This was kind of 7-8 years ago, I don't remember exactly, where we helped founders that were employees to launch their companies. And during this experience as a director of this accelerator, Founders Institute, which was about the Sofia chapter, which now is like an Eastern European chapter, but we started only with Sofia. I saw that there was something missing on the market, and there was not an organization that is kind of helping the angels. So normally in a mature ecosystem, you have a lot of angel networks and clubs or some kind of syndications that are active on the market, but here there was none. There was one that actually was not actually active at all. So I went to them, so asked them, let's do something, but they say, okay, we don't have time for that. They were doing something else. So I said, okay, let's start one. And then I went to my current co-founder, some people that I knew, And George Brashnarov here is on the picture, one of the co-founders of the club. We started the CEO Angels Club, which grew to be, at the moment, I think, the biggest angel network and most active on this market. It's not as big as we wanted it to be compared to other angel networks on other markets, but still it's something that we built as a platform where we meet companies that are looking for funding with angels that provide smart money and also help with their networks, contacts, etc. So these are some of the parameters that we have. We have 29 deals, 90 members or something, yeah, I think they're growing. And we've invested this 3 million invested capital. So yeah, this is about me and the club, but there's something also else about me that 2.5 years, actually we started a little bit earlier, but 2.5 years ago we started the angel co-investment fund called Sofia Angels Ventures, which I'm now working full-time there. I'm still a chairman and co-founder, obviously a shareholder in the CEO Angels Club, but most of my time goes to this fund, which is, there are a lot of synergies, there's a lot of common ground between the two organizations, but they're two separate organizations. So this is a fund where we have 13 million provided mostly by EIF, the European Investment Fund, but also our own money. I mean, by saying our own, it's me and my two other partners that we have to co-invest alongside angels investors. So this is we've invested already in 10 companies for 2.5 years, and we have another 2.5 years to finish the investment period, and after that we have to sell the companies. So we are looking for deals where there are angel investors that invest alongside our fund, and vice versa. Deals are coming to us where they say, okay, give us some money, but we tell them, okay, do you have co-investors? So this is kind of a game we're playing, and the level we are positioning is exactly where the angels are, maybe a little bit later, because we would like to see more traction. You will learn what is traction later on. And we invest tickets from 200 to 500K in one round, and always with private co-investors. It's from one side a good thing because you're working with angels or other private investors that validate a certain kind of thesis and a deal, they help, but it's kind of limiting because you cannot close very quickly any deal. But this is a mandate that we have. We just talked here with Yavor that we have the privilege to be able to invest also outside Bulgaria. So 50% of the capital should be invested here, but 50% could come from anywhere. So we were talking about the deal flow there and what kind of deals we see and how they are different from the ones that we have here. And yeah, it's an exciting journey. So yeah, if you are investing in a company and you need a partner to match your investment, let us know. Sofia Angels Ventures is here to do this exactly. So we'd just like to, I know some of you very well, some of you I just know, and some of you I don't know at all. So just would like to understand what is the audience here. So please, if you have invested already as an angel in one company, raise your hand. Hand, yeah, not head. Yeah.
At least one company? Or?
At least one. Just, okay, so we have 5-6 people. And then, okay, so is there anybody that is at the moment interested in a company to invest in? You still have not closed the deal, you still have not transacted. Okay, so there are. Okay. So this knowledge that we're going to share here today is for everybody. So maybe some of you, some of the things I would share, you will already know. But this is like a first time entry level of the game. So then we probably plan to choose a topic here from this one and go deeper. But let me know if you're interested in something in particular. It might be the term sheet, it might be the investment process or the valuations. This is not meant to be like in-depth educational academy, because we wanted to do one actually. We were planning to do, but there were not enough people that signed up, so we could not afford the external trainers that do this like a profession. But if we see that there is particular interest in a particular, let's call it vertical, we can do that. We already done this. We've done one session with EY about valuations, professionals. It was, the feedback we got was very good. So we had one session about term sheet on our retreat. So, but the thing is that we always have new members coming in, and they have not attended the previous one. So at the moment we're trying to fill this so we can have some material and content and legacy for them. Okay. So just to give you also an understanding where you are going into. I mean, the angel investing is pretty what that this slide means is that angel investing is pretty important. It's one of the main drivers in any mature ecosystem. That's what we want to do here in Bulgaria, also to establish it as an institution and as a driver that helps entrepreneurs to build awesome companies. These are some numbers that we have from the European Business Angel Network, which is the organization for the networks like us in Europe. It's one of the two. And so you can see that this is for which year, Eli? Now,
2021, 2 years ago, I think.
Okay, so now the market is a little bit down, so less capital is going into venture capital, but I think in 2022 was the record high year ever for the world and for Europe. I think we have later a slide on that, but that just give you understanding that the angels are providing half of the capital, more than the venture capital professionals themselves, because there are a lot of, I don't remember the exact number, but I think that in US there are 3,000 networks, clubs like ours, and in Europe, yes, in US and Europe, I think it was around 500. You can imagine how many people are doing this already, and they have been doing this for years. Of course, this is something that started a long time ago. I mean, there were these angels that were funding and helping the Broadway shows in the beginning of the century. They was later going to back up movies. What the type of angel investing we're talking about here is the one that goes to help tech companies, scalable companies, companies that have high growth potential. Yeah, and this is, yeah, you can see how fast it's picking up, because I think now we are at the moment when this kind of movement, if you want to call it, an activity is being democratized. It's becoming like something for everybody. Not exactly everybody, but let's say for, you don't have to be rich to be doing this. I mean, you have to be motivated to be doing this. So there are different kind of things that actually motivate you. We're going to talk this in a while. But the bottom line is that this is happening, and it's happening now. And there are a lot of, it's easier, it's more rewarding, and it's faster in a way to get your return, whatever the expected return is. So yeah, this is actually the profile of the angel investor that we've kind of extracted here. So first of all, these are individuals who invest. They have to invest their own money to be angel investors. Not if you invest other people's money, that's not an angel investor. That's a fund manager. So invest in high growth companies, because you have seen people that have given money to their cousins to open up a restaurant, or they're kind of angel investors, but we normally don't call them angel investors, because it's more traditional, it's more, let's say, it's more traditional, and the type of business is mortar and brick. So that's important thing to understand, that in this domain we normally look for high growth companies. So what are the amounts that people invest? Anything from 5,000 to 500,000. In the club, we have some people investing a lot of money, but most of the majority of the people are kind of looking for tickets around 5,000 euro. This is also good to mention that if you would like to invest less, like 1,500, probably this is not the right asset class for you. There are crowdfunding platforms which are catering also for angels where you can do that. But in the angel world, we kind of expect the amounts to be bigger, and they're getting bigger and bigger because it's becoming more expensive to run a business, and the founders are expecting that. And also we see this kind of trend that the founders are kind of reluctant to deal with tens of angels. They would like syndicate, they would like one bigger entity because it's really complicated. I've seen this already in a couple of deals where we have 10 angels, 2 funds, and it's a nightmare for the founders and also for us, but for the founders. So the angels always co-invest with somebody. They're normally not on their own, or they no lone wolf. So that's why the clubs and the angel networks are a good thing. And that's what we provide actually as a product. We provide a network club where you come and you can do deals with others. They share their deal flow, they help each other. Everybody knows different kind of things, have different kind of contacts. So the difference here is that the angels take quick decisions because it's your own money. You can be emotional, you can think about it, but still you are faster than the professional investor. It's not always like this, but normally you should expect this difference from the venture capital investors. And but it's another thing that it's also good to mention is that investment period is much longer than probably other more liquid type of asset classes, like, for example, to buy some kind of stocks from where you can buy them today and sell them tomorrow. Here, you can buy the shares today, but you will have to expect that you will probably sell them in 7 years. Sometimes it's faster, most times it's not. So you have to be patient. If you need this money, don't invest them. Just have to. We have a slide for that liquidity. So. And again, this is a very high risk kind of asset class. Most of the investments fail, but there is a way to overcome this through portfolio. We'll show you this later. But it's a risky asset class, so you have to, in some geographies, you have to be accredited investor to understand this and to be able to invest. In Bulgaria, we still don't have it, but probably it's coming. What does accredited investor means? It means someone that has certain amount of money in US. I think it's the annual income should be around 200,000, or the net worth is $500,000. But if there is a wife, it should be 1 million, and they have to be member of a club, things like this. So if you would like to invest, you cannot. The bottom line of this protection is. To get rid of the scam. So because in the past there were a lot of people selling things to people that don't understand it and they lose their money, so that they're trying to protect the educated investor. But in Bulgaria we don't have this, but still it's a risky thing. So if you go into this, you should understand this. Yeah, but the rewards could be much bigger. That's the thing. That's the lucrative part. Okay, well, I just mentioned about the difference between angel investor and the crowdfunding investor. So there are some awesome crowdfunding platforms. We are working with one of them, so we can kind of facilitate also such deals. I don't know how this is working out. This platform is called Seedlink, where we, if the tickets are smaller, we just kind of tell to our members, we have this deal, we're raising 550,000 So if you would like to put 1,000 or 2,000, go through that platform because it's digitalized, it's more efficient. So I think we still have a couple of deals in that platform where you can go and, but it's not something that we focus on because at the end of the day, angel investing is about smart money. So what are the reasons to invest in startups? So who picked up their hand here? Okay, Danny, tell me, what was the reason for you to invest in a startup when you did it the first time?
It was really appealing to me to invest because I have financial background. and I like to analyze things. I also like new endeavors, and it's really appealing to me to see how something does not exist, but later on, with my help, somehow it grows to become something really, really important. And that was one of the reasons. I don't really think for me the financial part of the financial side was really a big motivation, because I understand that it's very high risk, and I only invested that time money which I can afford losing. So
that's an important thing.
I think yes. I think for me it was mostly the interest in the domain and the way to see how my help really turns into something.
I understand. So the thing is that there are different type of motivations that we've seen and that actually our colleagues have shared throughout the world. Most of the times it's not about return, although this should be kind of in the design, and but it's about giving back and helping. Most of the time it's also about doing something interesting. We've seen a lot of angel investors that kind of bored from their corporate job, and they just like to do something else that is meaningful in a way to learn new things, to get involved in. But you have people that would like to expand their network. So what I would like to say with this slide and this topic is, for you have to be clear about your motivation. This will kind of design your strategy and the way to get involved, what to do. Just ask yourself, okay, why I'm here, why I'm doing that, and this will help you to become more successful as an angel investor in terms of realizing the expected return. And this is some of the investment drivers that actually will help you design your investment strategy. What is the expected return? What type of return are you looking for? Is it some kind of impact, or is it money? Can you quantify that? So spend time to reflect on that, and I think it's a good exercise. We're not going to do it here like for everybody now, and we're gonna give you this for some kind of self-reflection. And another thing is, okay, how much capital I can allocate for that? 10,000 euro per year, 50,000 euro per year. But you should be able also to understand that this is a long-term game, so you just plan it not only for 1 year. Okay, you can try it. If you don't like it, you just quit. But still, if you want to have return, you have to realize that you have to do this for 3 to 5 years at least, so you can get some of the results that we think that you can get. And another thing is for you to decide and to think about is, how can you help the startup? Can you help the startups in some way with your network? You are as a manager or as a exited entrepreneur, can you give them good knowledge and support? Are you going into in the board of the company? Can you get more involved? How much time can you spend with that? Because this can help you to multiply your investment, and it means a lot for the founders. But still, you have to, then when you know what you can offer, you can search for companies that actually need it. I have a co-investor that I've been working with for quite a while. He's a CEO of a successful executive search company. He's very good in sales, and he only searches for deals to invest in where they have synergy with his business, where he can help them either with his contacts on a high level that he has in the advanced process manufacturing automotive arena, or even or such that actually need coaching in terms of sales and proactive direct selling. That's his strategy, which is he designed his strategy according to the value added that he can provide. And again, how much time do you have? Can you afford to do this in terms of time, not only money? Is this a hobby for you? Is it passive? Are you active? Of course, the more active you are, the better it is. So, okay, this will lead you to the situation where you need to kind of design a strategy. That's what actually we as a professional fund managers, we also do this before raising a fund. So we went to EIF, they asked us, okay, show us this exactly. Not only this, but this was some of the things that we needed to show them. And it went into our contract that we need to do this. It has limitation, it has focus, but it helps you to be efficient when you start to invest at the end of the day. So you have to decide of how big your portfolio should be. We have some tips for you, but you might be thinking a different way. You might want to build a bigger portfolio or a smaller, depending on your time availability, on your deal flow. Can you spend time evaluating all these deals or not? On the ticket size, okay, you can be very disciplined about it. Should I invest 5,000, 10,000 per deal? How much can I afford? And what is the you can correlate this to the size of the portfolio that you want to build. You know the total amount, and you can split it. And then again, are you focusing in a particular sector or vertical? Does this make sense for you? Maybe you're a doctor, you're coming from the health care system, and you understand this kind of business, but do you have enough companies to look at in this domain in Bulgaria? Maybe not, because we don't have a lot of good biotech, health tech companies here to build a vertical specialization. But if you would like to invest in any European company, maybe that's a good idea. And it could be the stage of the company, early stage, later stage. This is something that should be kind of designed. Of course, if you're an angel, you can be flexible, you can try, you can experiment. And again, the portfolio management, you have to realize that once you invest in this portfolio, let's say of 5, 10 to 20 companies, then you need to manage it. That's the harder work. And it's sometimes more unpleasant. Because when you invest, it's exciting, everybody's happy. But then when you close the deal, when you have the founders spending some time in the reality, a lot of things happen. And sometimes shit hits the fan. And you need to be there to clean them up, and yourself, and to deal with failures. So this is something for you to think about. Do I want to have this strategy or not? Again, this is more for professionals, but if you would like to be serious about it, why not consider it at this stage, even before your journey, or once you have 1 or 2 deals in your pocket. So this is an idea for you how you can search for deals, which is an important part of the whole process, because at the end of the day, for you to close a deal, you need to have things to choose from. I think now it's much easier if you wanna, if we focus for a moment for Bulgaria. I mean, sometimes you think, okay, then there are not a lot of interesting companies that I meet here, but think about it in this way, like 10 or 15 years ago, there were even less. It was the startup VC angel ecosystem was probably not existent at all. So, but now we have a lot of interesting companies. We just need to know where to find them. Of course, one of the best channels is join a network. Be part of an angel network. That can only help you to enrich the type of companies, the number of companies you see. But the other thing is, okay, you can be more proactive about it. You could go to other events. Once you become a little bit more experienced, they will start to invite you to become a mentor, to become a jury member of all these type of competitions. And another way, smart way to do it is go to some venture capitalists that are doing this daily as their profession, and help them. So they will help them for free if you want, just to evaluate companies. If you're good at tech, if you're good at certain kind of profession like financial or commercial, help them evaluate the opportunities, then help the companies to grow later. And you will have an interesting pipeline, and when they have something interesting, they might call you to join. We are a fund like this that we have to do this by design, by mandate. but there are funds that can invest on their own, but sometimes they don't want to. They just want to have someone with skin in the game like you that knows a certain vertical, knows a certain function can be helpful, and they will invite you, which is another way to generate deal flow. And the other, of course, the long-term thing is because you have some angels with you have some angels that do this already as a profession. I met a guy in I think it's how do you call it now, Netherlands or Holland, yeah. He had invested in 200 companies. How? I don't know, but he built like a brand for 10 or 15 years or more. I don't know. He was an old guy, and so he built a brand around himself. So he's more popular than most of the funds in Benelux. So you can do this as well. I mean, how you going to do it's up to you. But at the end of the day, it's about creating some content and sharing with the world. You have these blogs and blogs. A good way to build your brand is to help founders, help them for free, be a mentor to them. They talk amongst each other. They can refer you good deals. The founders are normally a good source for another good deal, and just show to the world. In Bulgaria, we have this thing in the past that when you are when you're a rich guy, if you have invested, you don't want the other people to know because they will start to say, okay, this guy is filthy, he made his money in a wrong way. Maybe he did or she did. But the thing is that at the end of the day, if you show yourself to the world that you are an angel investor that is actually doing this, people will start little by little come to you and talk to you. Sometimes this is kind of a tedious problem for some people. For me, it has become one. So I try to have barriers because you cannot pay attention to everybody. But at the beginning, you need that to open up. And then if you are in a network, we kind of expect this from you because in a club, an angel network is not only for the club itself should not only be the only generator of the deal flow. The deal should come from the members. So you can find good deals and share it with your buddies and other co-members, and then they will share back good deals with you. And this is the synergy that we're trying to promote. And I think it's a win-win situation for everybody. But basically, these are the things that you can do to generate deals. That's what we do as professional managers. That's what you can do as well. It just takes time, as anything. So this is a structure for your decision-making process, just to give you, to help you get organize the entropy in your head. But at the end of the day, you can act in a different way if you want. It means that you need to do your homework. You need to research the things that you're looking at before investing. You need to meet the people, talk to them. Even if you're in a club, don't rely on a group meeting or on a deal leader only to share impressions. So do your homework, meet the founders, see if you have synergy with them, ask them the smart questions to evaluate them, and then make the evaluation based on this criteria, or like team, market, product, business model. Do you like them? To decide if you want to invest in or you don't. So what is research? Normally, the research I do, you have different type of investors, or even in a fund, you have me that is more looking at people and sales and marketing, but we have my colleague is more oriented on financials and looking at financials models and planning. But at the end of the day, at this stage, the most important thing I think we all agree on is the founders. So make research on them, who they are, where they come from, what they have done in the past. Now it's so easy to do it. I mean, just look at LinkedIn or go in their Facebook page. You will learn more than their wives and husbands if you see what they're doing and posting. And most of the people do have such do have profiles, but and you can see it. Even if you Google it, we find sometimes funny stuff and dodgy stuffs about people being in some kind of court battles or things like this. So the other thing is about the product. Test it. If you don't understand it, just find someone that does. It's kind of easy also to get product feedback, technical feedback. I've seen an angel investor that told me that he never invests in a company if he doesn't use the product. He has to be using the product, like an app that he uses every day. He likes it, so he invests only in such kind of. That's not my approach. I don't have to be a user to be an investor, but it's a good strategy because at the end of the day, if you don't like the product, why would you invest? It's a research you can make easy without too much complicated due diligence. We have in the second session a slide for due diligence. You can have technical product due diligence done by third-party professionals, but I don't think this is for angels. Even early stage funds don't do it because they don't have time and resources. But still, product is important. See if it works. Go on their website and see what they're selling. And of course, you have to look at competitions. Sometimes it's very tricky to do it because most of the competition is not yet visible or maybe not even existing sometimes, or it's doing something in beta. If you ask the founders to share the information about the competition, they have some kind of a pre-framing in a way. Okay, these are the competitors, but everything that we offer is much, much better. Don't trust this because sometimes they're hiding information if you're lazy. Sometimes you have to Google it and you see that there are other companies that are doing exactly the same. And that's my personal advice, be more scared from other startups that are doing exactly the same that just got a lot of funding. They are more aggressive, they will be faster than the incumbent dinosaurs like IBM, SAP that don't care about this problem at all. So normally you will see something that SAP has already done, and you have a startup that has shared that they're doing faster, cheaper, and better, which is fine. At the end of the day, SAP has done something like 20 years ago, and it's very expensive. And if you have something that is like 10 times cheaper, it is possible that the customers would buy it. A lot of things, other things can happen that they will not probably take the decision to purchase it as a business customer, but still it's a good thing. But if you have another startup that actually has a marketing power and have raised money from US investors recently, probably coming to your market, then you have to be careful. But still, yeah, make your research. It will reward you. Meet with people. Now it's so easy. You can do this online. It works. Actually, it's kind of boring not to meet them in person, but sometimes it's very efficient. And we do this more often in our fund, because we started the fund during COVID times, and it was kind of okay, this was the reality, the situation. Now we're still doing it because it's easier, and we can interview companies and founders from all over the world, literally. And it's there are no limitations for that. And of course, you can play a lot of we're doing with time, so we have
We don't have a lot of time, so we can.
How many slides do we have? Yeah, we don't have time yet to spend on the interview itself, but basically it's what do you need to achieve during these meetings and research. You can actually discipline yourself, have 1 or 2 meetings. You can have research for 1 week, but at the end of the day, you can be flexible about it. So sometimes, if you are more people, if you're in a group, you can split your work, and the others can share the information and report back. You have a deal leader. Sometimes, normally, the deal leader is doing this for the group, but it should be done. So, yeah, again, the team is the most important part of this stage of the journey. If you go into private equity stage, later stage, maybe the team is not so important because you can be changed. But trust me, pre-seed, seed level, Series A, Series B, it's always the team. They can make it or break it. And you have different kind of approaches here, but personally, I would like to see the team dynamics, how many founders, how long have they have been, because I'm very careful with the founders' relations. If they've met just recently on a startup event, that can be dangerous because they haven't had the situation where they were exposed to conflict. And how did they handle that? Because most of the time, the things that actually make company fail is when the founders give up or quarrel among, develop kind of fight that is reaching to a stage where it's impossible to get along. And
Annie has a question.
yep.
I was wondering if it's better to have more founders on the team, or maybe how about one-person show?
It is better to have more founders, but the data shows that's not obligatory for a company to be successful. To have like 2 or 3 founders. It could be a solo founder game. But at the end of the day, why is better to have more founders? Because a lot of things happen, and you have if someone gets sick or someone has another priority in life, and you have people to work with, and it's very difficult if you. That's a problematic situation when you have a commercial person or a business person and a CTO going together to do it, and the CTO just quits because someone paid him like 10,000 euros salary. To find a replacement of this person, first he has to be willing to do this, has to be technically capable, and then on top of that he has to get along with this the other co-founder. That's and if the job requires this to have a CTO or let's say senior developer, and they don't have a lot of money, they have to do this themselves. It's a dangerous situation. But there is not a right answer. So don't shy away from solo founders. It is possible that they can make it. That's my personal opinion. So yeah, evaluate the product. Again, this is kind of repeating myself. But always think about, okay, is this going to make me money? What kind of return can I make? Is it possible to exit this kind of company? This is a very important question, because sometimes you see something is very good, very interesting, very exciting, but the founder doesn't want to sell. I mean, he would like to do this as a lifestyle business, or maybe he wants to sell and to exit, but the type of business will be developing into a business where it's not sellable. For some reasons, maybe it's kind of a consulting business and nobody will buy it, or some kind of professional services. So think about this, because you're an angel, you have to exit so you can get return. If you're an evergreen angel that would like to give money to companies and just work on their board, that's okay, but normally these are not the type of deals that you will see here. So think about the exits. And as a whole, you have to think about all the risks in this journey. So there are different type of risks, but think about what is the risk here? Is this a risk that I'm willing to accept? So yes or no moment, what I would like to say here is that you will have to say a lot more no's than yeses. So I think we have a slide about that, how many deals you should see so you can say 1 yes. But when you say, be prepared to say more no's, because otherwise you run out of money and time and just invest in every first company that you see and the founders that you like, because they are likable, they're charismatic, they're energetic, they're gonna change the world. But would that be an investable case? It's a different story. But giving feedback in the right way helps you in the long run. Be aware that you have to give feedback in the right way so the people can come back to you for later when they have a better project. Okay.
Annie has a question.
Yeah, da?
I was wondering, how do you evaluate the possibility of copying a business? Maybe is it important to have a patent and...
Of copying a business?
Yeah, I mean, because
Same
every idea
something
can
similar.
be done by somebody
Yep.
else.
IP protected by patent is a good thing normally, but it's never, you cannot be sure always about it, and there is always a potential of someone copying a certain type of software or business, sometimes seeing other people trying to copy it is a good validation, not a scary thing. That means that there is a product market fit, which is normally a bigger problem. Are they building something that the market wants at this stage? So actually competition is something that is validating the market, at least for me. But is it possible for someone else to copy it? Yes. Are the barriers of entry high at this stage? I don't think that they're very high, but still you can kind of also evaluate that, because you have founders that have spent 2 or 3 years developing a code. So if someone just would like to do this right here, right now, they have to go through this journey again. If they have just gotten a lot of funding, it's possible to overcome this founder very quickly, but it's unlikely. That's kind of the thinking that I have. And what we are looking for to evaluate at least is the so-called traction. You've heard this traction. It means progress, but meaningful progress. That means something, because you will see a lot of founders sharing bullshit. Like the type of traction that they say is that we have a very good web page that is designed by the top designer, or I've been to Webbit in Portugal and I had a great boot stand. And these are vanity metrics that they share most of the time, but the real traction is sales, ideally. Yeah, if someone paid them good dollars for this product, that means something. Do they have customers? Are these customers growing? If they are earlier, do they have a product that is actually awesome? It looks good, an MVP in the hands of the customers. Sometimes it's about the vendors, because if it's a business where you have to organize a lot of suppliers for your platform, it's good to see what they have done in this direction. IP can be a good traction. Have they patented it, or are they planning to do so? And of course, do they have money in the bank that will actually help them survive the investment process? Because the investment process takes time. And sometimes you speak to someone because you're a slow investor, and in 3 months they've closed the company. And valuations, okay, we need to speed up here. Valuations is something that you can do at this stage. Probably as an angel you will be not doing that, but still you have to be aware and you have to be able to negotiate, because valuations are important. They're going to have direct impact on your return. Okay, the cheaper it is, the better it is, but then you should have balance. Because if it's very cheap, it's a red flag. Or the founder will be diluted very fast at this stage, and maybe later stage investors will not enter because of that, or you have to be prepared for that. So what you need to remember here, that there are different kind of methods about to do it professionally, but I think that also valuation depends very much on these 2 factors, timing and market. What timing means is when they are coming to you to get the money, do they have let's say runway in their bank, the things that I told. If they don't have money, they are willing to lower the valuation. And then the other thing is the market. Is the market ready to offer them better price? And what is actually happening is that the moment the valuations are much lower because the market is stagnant, the investors are reluctant to put more money, and the valuations previously were very hyped. You know, that it was like the founders were probably, it's not their fault, but they were just following the market. All this type of fast investing in the search of unicorns had led to valuations that are overblown, and now these balloons are booming around the world, and the valuations now are, I think, 2 times lower than they were a year ago. And in this market, the Bulgarian market is kind of responded slowly in this direction, but I think that now the people are realizing that they have to be more realistic about this expectation. But still about the market, at the end of the day, your company costs as much as someone would like to offer you. And we're not talking here about buying a company, we're talking about buying a stake in the company. And you have to see this in the context of the long-term journey where there will be other rounds. So normally you have to remember, you will be not the last investor of the company, but you will probably the first investor in the company. And other investors will come later. So in a way, try to be sensible about this, but don't spend so much time. Normally you do it with other professional investors. They will help you to, these are some of the valuation methods that are comparing the company with other similar transactions in a certain kind of period, in a certain kind of vertical, or maybe some other public companies, which is not exactly relevant. Sometimes helps, because if you don't have an analog company, you just look for something that is on the stock exchange and just compare it. You're looking for multiples. You have the most popular is the discounted cash flow, the so-called DCF, where you have the founder giving you 5 years projection. And of course, it's kind of a fantasy, but you kind of see if it's realistic or not, the growth, and you discount this back in a way to see what is the net present value of the company. You have actually online tools that can do that, but just don't accept any valuation that they give you. Normally, you have to give them another figure, and you will get a lower price. So just negotiate back, and the founders respond. The way that they think is, okay, do I want to get diluted a lot? Maybe not. Normally in a round, I will get diluted only with 10%. But that's their story, so your story should be different. And you have these other two methods here. And this is a good way for you to think about valuation if you want. This is kind of a practical. It's coming from David Rose, one of the most prominent angel investors in US. It's his idea. So basically, this is a way to value and praise execution. Execution is key. Ideas don't cost almost. I'm not saying that they're worthless, because everything starts from an idea, but when you try to price them, they don't cost a lot. So an awful idea is -1. So you should run away from such ideas. But let's say that it's a so-so idea with great execution. You have to multiply the number that is on idea with the execution. So if you have a brilliant idea and a brilliant execution, the company can be close to unicorn valuation. And you can play with this, but it's a good frame for you to think how much a company costs. If you start to do this for a while, you will see how much would the company cost in a certain market at a certain stage. There are ranges. Of course, you have sometimes crazy founders with crazy valuations. Sometimes they have the vision and the justification for that. But yeah, at the end of the day, we're looking for these things in the company at this stage, which are connected mostly with the founders, which are passion, integrity, experience, knowledge, commitment, and coachability. Actually, this is an important one, coachability. It's something that is people neglected at the beginning, but it's what it means that the founders should be willing to listen and to learn, but at the same time, not always. Yeah, which is okay. But they're looking for feedback, and they're progressing without feedback. Actually, there was when I was a founder, I used to research who are the best founders. The best founders are in the middle of the agreeableness measure. And this test was designed by Jordan Peterson, the so famous Jordan Peterson, who is saying that the best founders are not very disagreeable, who neglect everything and always against an opinion. They are aggressive, they don't like to learn. But we're also not looking for people that are very agreeable, that always say yes, they listen to everybody, and they don't know what to do. So at the end of the day, you would like founders that are knowing what they want to do, but they're willing to learn from the investors. Some figures, normally you have successful angels investing in at least 20 companies in the long run. This is kind of normal for outside Bulgaria. We cannot say this, but this is something that works. They invest normally around 25,000 euro in a company. And you have syndications, they normally do it with others, 5 to 10 people. In the club, you can do that. You have always 5 to 10 people interested in a deal, which you normally close when you have a kind of distinct deal leader. And this is also an important number. You have to be prepared to look at 40 companies before you close one deal. Yeah, so we don't have to invest in every. You would say, okay, in the club we don't have so many companies. Okay, but you look for other companies. When I say looking and reviewing companies, that doesn't mean that they have to be invited here and you have to be like 3 meetings. But still, you get some pitch decks. You get on an event. You see them in some of the platforms to get an understanding and also to be able to have a choice. And this is individual angels receive 5 to 50 pitches per month, and groups 100 and more. That's why it's much better to be in a group, because this is kind of a. Can you imagine yourself to look at 50 pitches every month? Probably it's not something that you want to do. But if you're in a group, you can kind of synergize from the work of others. Before we go to the next session, we have a few more to talk about the first part, which is before the investment. And actually, there were some comments here during the break is about it will be good to go deeper in a particular subject or topic. Just if you have this kind of interest and you have this smart question, just stop me and ask me so we can go. I know that we don't have a lot of time, but still I think that the other 2 sessions are a little bit more flexible. So if you're interested in something, just ask. And if we don't have time, we'll just move on. But don't be shy. Just ask me the things that you are interested in. You have something to share about it. So yeah, this is a very general, or let's say common kind of question that we get. How much money should I invest? Of course, you should be the one to be able to answer that according to your budget, to your income, to your money in the bank, your kind of risk profile, what kind of person you are. I'm personally a little bit more risk oriented. I would like to. Okay, I'll say my father was a gambler, but he used to play poker, yeah, and but I decided not to do that. And I decided to, yeah, I became a venture capitalist at the end of the day. Yeah. So yeah, in a way, this is a way to satisfy my hunger for taking risk, but doing it in a smart way. So yeah, you should be able to answer that. And then there is a rule of thumb here. Is some people say 5 to 10% of your net worth it's a smart way to approach to this. But there is another thing that is also useful, is to have 3 type of buckets for your type of investment. Let's say that you say, okay, I will invest 100,000 leva per year in anything. Then 1/3 will be in something that is very stable, and that is something that has low return, but I know that I can take my money out. Which at the moment it doesn't seem like a very easy answer. What is that? Is this government bonds, or is it Bitcoin? Is it stocks? So Bitcoin is not in that bucket at all. I mean, don't get me wrong. Is it a deposit? But what would that deposit bring you? Maybe it's an apartment, but can you buy an apartment with 30,000 leva? Probably not. Then this is a good way to think about it. 1/3 goes in a safe, secure. That 1/3 will go in a risky bucket, which is okay. Maybe angel investing for you. For some is crypto. For some is something else. I don't know. What other alternatives do you have to angel investors? Can you share one? Risky ones, but exciting ones. Anybody? That's a question. Crypto, I just said it. Crypto, and then it's stocks are a little bit more secure because you can exit them anytime. Of course, they are risky.
Just like the crypto, you can. Yeah. There is a very high liquidity there.
Yeah. Okay. In terms of liquidity, you're right, but in terms of risk, probably not if you buy these blue chips. But and one.
What's the idea here? The main thing is what's the idea of a portfolio? Is it for, I don't know, retirement plan? Is it for growing your, I don't know, savings, or
Yes,
what's
exactly.
the idea of the portfolio? So it should be a different strategy.
It should be a different strategy, but it's something that it's just giving a framework of thinking. It's well, the last bucket, which it just invest in your life, in type of experiences, because it's kind of important. So this could be your hobby, it could be traveling, but I mean this is just some wording here.
You can buy, let's say if you have hobbies or businesses that you are aware of, you can buy shares and you just get, I don't know, some dividends from them.
And this is outside your main business. Let's say that you have a factory and you produce clothing and it's working, is doing well, and you get some cash out. I'm talking about this cash out. I mean, not talking reinvesting in your business, but probably reinvesting in your business is the best thing to do. Yeah, this is what it is to be said about this at the moment. But where I'm getting to is, once you know how much money you would like to invest, once you know your risk profile, you should be able to build a portfolio. And why portfolio is important is because this will actually bring you a return. I mean, building a portfolio, not investing. If you invest in one or two startups at this stage, probably you will lose your money. You have to be prepared. So if you're not prepared, don't do this. But if you build a portfolio, then you become a little bit more like a VC, but you need to be patient. Yeah? So normally it's no less than 20 to be sure that you're gonna get out something. But the truth is that the higher the number is, the better it is for you. And Isto обаче то с кликърен се прецака.
се измъкнала флашката, която влиза в компютъра.
Okay. This slide will show you that is okay. It's a slide that is based on some statistics. It's gained by this guy David Rose. The higher the numbers in your portfolio, the better the return. At the end of the day, that's what the data shows. It's not something that I'm making up here for you. Just try. I think also Jason Calacanis talks a lot about it. So just try to find a way to build a higher portfolio, a larger portfolio, which means that probably you have to invest less in a particular deal than. So at the end of the day, if you invest 100K, don't invest them in one deal, you invest them in 5. And why? Because this is a lot of big numbers, which I like at the end of the day, is the more bets you make in life, yeah, the more possibilities open for you to be right. So, but you have to be able to sustain the energy to make these bets in life. So here is a good visualization, which I like to use. 50% of your companies will fail completely, zero money back. Yeah? But 20% might return your initial investment at the end of the day, and 20% maybe 2-3 times your money, and you're looking for this 9 or 1% where you will have higher than 10 times your return, which is the rainmaker for your portfolio. And this average ARR is average return rate is for this asset class. This is an American example. I don't have any data for Europe or Bulgaria. It's around 25%, which is much better than most of the other asset classes like bonds, like stocks, all these things. And yeah, this is also a good slide. Normally, you will hear this a lot. The companies are the venture capitalists and the prominent angels are looking for unicorns. Unicorn is a company that costs not cost, but that is worth more than $1 billion, which is kind of also a vague type of valuation because it's normally reflecting a given round. For example, we know Payhawk, it was evaluated over 1 billion in a particular round, but it was like 2 years ago. Maybe if you evaluate them now, they will be less because of the market. But still, at the end of the day, these are the companies that actually you can make a lot of money if you're lucky to get into one. But they're very rare. The reality is that they're rare. So there is another Silicon Valley kind of a term, a buzzword that they discovered. The company is called gazelles, which are the majority of the companies actually that make money for the investors. And they are growing fast, not like crazy fast like a unicorn, but still growing fast. And they have revenue at the stage where you are looking at them as an investor. Maybe they're making close to 1 million. Probably they'll be more expensive than the one that you see here in Bulgaria, but still, if they're making $1 million per year, that's a good thing. And they will be the ones that actually it's kind of likely to be produced by this local ecosystem. I'm not saying this to discourage you to look for unicorns, but the unicorns are being kind of coined on a market that can actually produce them, and you have enough customers. And these are the American market. Sometimes it's the EU market, but then wait, защо такова вибира някакво много странно. Okay, ако знаеш какво да направиш.
Някакви минути пусна.
Да. И so be kind of realistic at the end of the day what you can get, and this is what to be said here about this. Was there another slide here? Oh yeah, we've shown this. So yeah, the next session is about the investment process itself. Let's say that you found the company, you evaluated it, you like it, you would like to invest. So what is going to happen after that? How is this process going? Again, if you have any particular interest in one of these, we cannot cover all of these in depth, but this is just to give you an idea of what is out there, so you can dig further. Maybe we can organize an extra workshop on that, or maybe a private discussion. At the end of the day, it is something to help you to structure your own process. So maybe when you join a group, a syndicate, what to expect from the group. Again, we have the deal search, we have the deal screening, choose the right one, meeting the founder. Then you have soft commitment. We are here on number 4. So the soft commitment, we heard this a lot. There is hard commitment, soft commitment. What do you think it's a hard commitment for you? Term sheet, exactly. It's still not a binding thing, but it's kind of a harder commitment than just to say, okay, I like a company and maybe I'll invest. This is the difference. And then after that, you have to start the due diligence. You have to agree on the transaction terms, which is a legal work. If you are several angels, maybe you have to do the SPV, incorporate some kind of a legal entity to enter, which takes time, it costs money. This is something also important for you to understand, that just being an angel and investing once doesn't mean that you will not have other costs. You have costs for the legal entity, you have costs for due diligence, you have costs for maintaining your portfolio, things like this. And we'll cover also some of the due diligence highlights here. Again, I mean, the transaction process can be a tedious, long, time-consuming thing, which means that you have to prepare the type of documents that are required for a deal. Normally, as an angel, you don't have to know them by heart. I don't know them by heart, although I've done this already, because every time it's kind of different. Sometimes it's just a shareholding agreement, sometimes it's an investment agreement, a shareholding agreement, a adhesive incorporation, and it's country by country. So you have to work with lawyers about this. You cannot do this on your own. There are simpler ways to close deals. I've seen this already in some markets, but I don't recommend it here. I mean, the lawyers are affordable, use them. So due diligence, what type of due diligence are there? So you have the legal one, which is kind of the most important, but not always. I mean, if there is a company that is not incorporated, so there's not a lot to be done here. Normally, at this stage, it is possible that you will do the due diligence if you want. If it's very simple, it's very early. But if it's a later stage, the later it becomes, the more things you need to do by third party, but by people that know the complexity of things that can happen. Financial due diligence, this is reviewing the accounting, the reporting, the business models, the planning, the way that they approach pricing, the way that they understanding the margins, etc. But in a way, due diligence comes, this is very annoying. Да, не ме, то не знам, почва изведнъж да вибрира, sorry about that. In a way, due diligence comes after the term sheet. Actually, I don't know why this came before the term sheet. Yeah. Yeah, it comes after the term sheet because it costs money and it's a lot of work. That means that you already kind of decided to invest and you agreed on the commercial terms. And the due diligence aims to discover red flags for you to be able to address. Sometimes there are red flags that are deal breakers and you just discover that they lied and you don't invest at all. But most of the times it's just a red flag that you need to address before you give them the money. So you put this condition, pre-closing condition, in the transaction documentation. But if you want, you can do this before the term sheet. It's even better. But then it costs money. Who pays this money? You or the founder? Or you just kind of agree to share these things? We as a fund ask the founder to pay them based on the condition that we will invest in the company. It's kind of a part of the round because it costs around 5,000 to 7,000 euros, and the founders are not happy to pay it at this stage. But if it's very early, like accelerator early, maybe the fund will do the due diligence themselves and they will just invest their time. I think that what you're doing here in Innovation Capital and other funds is similar. They just do this themselves, and you can also do most of this work, so you don't pay to lawyers or some kind of other professionals. In the fund, we use another company that is for the financial due diligence. They are doing the review and writing reports sometimes before the term sheet, and it's very, very useful to understand the financials of the company, but also to show the founders and to understand how they're thinking about it, and are they really going to make business out of it, or they're just building a product. So you have.
Can you give an example of a condition that you can add in the term sheet if you find something, if you have found
Not
something?
in the term sheet or in the transaction documents?
Well, but because you said that during due diligence you can find red flags that you can after that incorporate in the term sheets.
No.
Or
In the final document that you sign with the.
Give an example?
Yeah. Yes, I will give you an example. Just remind me so I can just cover this. So you have a technical due diligence. That means that you find a software guy and just review the code of the company, or probably if it's some kind of hardware, you find an engineer to do this. So someone that understands. But this is also costly. And being part of an angel network is very good because you can someone can do this for free, especially if they're interested in the company to invest. That's the best way. So if you are 10 angels, someone understands the finance, someone understands the legal work. You have lawyers, we have financial guys, we have technical guys. So you can unite and you can do the the due diligence very well yourself, even before the term sheet. Much better than, let's say, a VC who has to pay expensive lawyers to do it and do it slowly. But if you don't have it, there are a lot of people that can do it. An HR due diligence, this is very rarely done, but I've seen it and it pays off. What does it mean? They take the founder should take some kind of assessment tests. So you have their psychological profiles. You can see there are already a lot of data that shows who can be a good founder or not. Of course, there is not one formula, but still you can see the team dynamics, etc. This is, I think, very good thing to do. Sometimes impossible to do because of timing, but if you do it in an indirect way, it pays off because you can see a lot of things. I told you that probably in the number one or two reasons for a company to fail because of the founders. They either give up, they had enough, or they fight amongst each other. So this could be sometimes shown in if done properly by good HR assessment. You can use a company here, you can do it yourself. So these are the legal due diligence highlights. What are the lawyers looking at, or you should be looking at? You should see how the company is structured, what kind of company it is, who are the stockholders, who are what is the cap table. Sometimes they give you one cap table, but when you look at the real deeds of incorporation, you see something different. You just compare. So in a due diligence process, you just kind of validate facts. That should be the approach. You validate the facts. You see what they told you is true or not. But sometimes you discover things that they never mentioned, and you kind of don't know what to do at this stage, and sometimes they are deal breakers. So in financial due diligence, you see that actually their accounting reports are different from actually what they shared with you in a form of some kind of financial report. So it's not corresponding. I mean, probably you can share more on that. You see, they're not doing properly the accounting. They're not reporting it in the right way. They're giving you wrong data. Not because they want to lie, but just because they don't know. Sometimes the founders don't understand the finance at all. So that's why we ask them to work with a professional to help them with that. Another important thing is the contracts that they have with the employees. Are they a structured way? Are they protecting the IP? So you have a developer working in the company. They leave the company. They say, okay, this code is mine. They sue you back, and you lose your money. So they have to be structured properly. The way that the employees are hired, the founders, have they transferred all the IP in the company in the right way with a good contract? So this can be kind of easily done by a professional lawyer. If you've done this 2 or 3 times, maybe you can do it yourself. It's tedious work because you read some kind of legal documentation, but it has to be done. I personally pay a lot of attention on the IP things, because at the end of the day, you have some companies, this is the only asset that they have, or maybe one of the main assets, in addition to the founders. So you have founders, you have IP, anything can be done if there is a lot of money on the table to back them up. And then in due diligence, you can also you can check the regulatory frame, because they might be operating in a domain where you need a license. They don't have a license. They just operate until they become big enough, so some kind of procurer knocks on their door. Как беше то? Attorney General. Как прокурор на английски? Prosecutor. So, okay. And you have this, we do this a lot, and it's becoming worse than better. These AML KYC checks, which is who, are they in some kind of terrorist list, so they have been prosecuted, are they coming from Russia in some kind of restriction, restricted kind of country. To be honest, because we are regulated by the KFN, the Financial Regulatory Commission here, we also report to EIF as a fund. They're very careful about these things. Sometimes we spend more time on that than anything else, and it's becoming terrible. You need a lot of people to do it. You need to pay to the lawyers to do it. So, but it is important. You cannot avoid it. We had a situation where we were asked why this company has an office in Afghanistan and Syria. So we had to explain them that this is they were helping refugees. Obviously, they needed to do that. So, and for example, Turkey has also went into the list, so you cannot have investors from Turkey. Yeah, that's because they were not keeping some kind of sanctions things. And we heard this also about Bulgaria going in that list. So yeah, you have to be paying attention to that. So, you know, GDPR, the ESG, this is a new thing, which is sometimes is important. ESG is this environmental, social, and government criteria. Is this a green company? This is has the right stakeholders, etc. So these are the main things that you can do in such a due diligence. I'm just gonna give you. Maybe we do a separate workshop on due diligence. That's why it's a lot of information. Some of the red flags. Sometimes you don't have a company at all, or maybe you have an old company and a new company. Who did it? Transfer the IP from one company to the new, and how is actually the costs being shared or the revenue. So normally we have one company that was a service company. They were software developers. They decided to create a product. They created a good SaaS product. They created a new company, but still the software developers from the old company work in the new company, and they get the investment in this company. They pay the cost to the software developers via some kind of dodgy invoice. Yeah, so you need to understand this thing, how it is going, because they're leaking out sometimes money in this way, and also the revenue. Where is the revenue going? So this is worthwhile actually spending time on to understand this. Sometimes it looks complicated, but it's not. But sometimes you have a lot of baggage and skeletons in the wardrobe to understand. And again, it's about the IP. Where is the IP really owned by the company? What kind of IP it is? Is there an ESOP plan? Yes.
I have a question related to exactly what you mentioned before about spin-off from existing company.
Mm-hmm.
Because there are such cases like service companies which are producing startups.
Mm-hmm.
So what is considered normal in terms of relationship between the spin-off, the new startup and the service company? If there are developers which are producing work for the startups, is this okay or not? So what is the recommended approach?
Talking about Fabrico?
In general, not only.
Okay. Basically, this is a kind of a normal situation, but is it normal to be left like this? I don't know. It's very much about addressing it, putting the light on it, and agreeing with some kind of action that is transparent for everybody, because you can pay. They have the investment. They got investment. They got 1 million, and they start to pay these developers by saying, okay, they develop the product. They need to be paid, of course, but these developers are also working on other type of clients and project that has nothing to do with it, which is not fair. So this is a tricky situation, but I would normally recommend that all the developers are moved, or at least we agree on a time frame where they moved in the new company, where they have a contract, they employ by it. But it's kind of a normal for a while to remain like this, because it doesn't make sense for the new company cannot afford them. Simple as that. If this is good for the new company, where I am a shareholder, I care about it, I don't care about the other one, that's okay. But they have to be clarity about who gets paid, how much do they get paid, and for what kind of work. Of course, they can lie about it, but still you have to clarify it in a way. So it is very common situation. There is a way to solve it, and you just do it, and at the end of the day, put trust on the CEO to manage it. But the problem is that things start to happen not when you agree with them. They start to happen in 1 or 2 years, probably, when this project that you invested in doesn't go well for some reason. Or the other company, the mother company, where they have the services company, is booming. They need more developers. So you cannot foresee that and you cannot protect it 100%. At the end of the day, it's about putting some trust, of course, and having a contract to penalize them if they do it.
The topic was a good example in this respect indeed. So your recommendation is that at some point of time, and we need to define what is some point of time, the developers which are contributing to the development of the product are kind of put into the entity, on payroll of the entity which is the startup.
Yeah.
Is this what you're
Yeah. But that's what we actually asked for. We wrote them a term sheet. So we asked to do it, but not immediately because this will slow down a lot of the things. But they have to agree that this will happen at the end of the day.
Okay, so what is this period of time that you say is recommended?
6 months to 12 months, something like that. I don't remember exactly, but it's. You can do that. You can say, okay, you have to do it. You trust the person, and they will eventually do it. But be aware that in 1 or 2 years, the importance of these companies could be different in the mind of the founder, because if they're not making money from this one and from that one, they might refocus their attention and their motivation. The other thing,
Sorry, can I also have a question?
yeah.
How do you handle the second topic where IP rights belong to one of the founders? So what's your suggestion, maybe some good practice how to solve this?
It's kind of very simple. They have to transfer the IP. That's a pre-closing conditions. I don't agree on that. They will do it some later. There is a contract template that we give them, sign them. I transfer all IP to the company, and it's in the company. Otherwise, I don't invest in this company.
But you mean as a capital installment? Because otherwise, if it is a deal like a sale or something, it will create a loan to the
No. It's not connected with money. You just agree that all the IP, whatever I have developed before, while we are talking, or in the future, it goes in the company as a capital installment. Yeah, it's not a monetary transaction. So.
And I assume same with loans and debts which the founder had financed the company before the.
Yeah, that's a tricky thing. Sometimes you discover that the founder has a loan because that's the way he put money in the company, and it's some of them they want to get them back, which we don't agree upon. But sometimes we might have to agree. But normally I would say if you have money, you have a loan, just settle it yourself. I don't want my money to go for you to pay your loans. I want to go in the company that for the development of the company.
Yeah, or you can settle with them that these loans will be postponed after your exit from the company. So basically, you've given 100K to the company, and okay, I mean that's your skin in the game. Get your 100K after we exit.
And it's also about the scale of things, because if they have a loan for 20,000 leva and the round is for 1 million, that's immaterial. So maybe that's what we have now with one Austrian company, is that the founder has taken a loan from some kind of a bank himself, and then from that loan he has financed the company. And if he doesn't pay this loan back, he will get prosecuted. It's a bad thing for him, but the amount was not big, so we said, okay, let's move on. But we believe that he was transparent, saying that there is such a thing. So either you have to agree or not. But normally, I would not advise for you to give money to extinguish fire. Yeah. So because there will be not money left for the development of the company.
Do you have some other red flags maybe the audience can share?
No, I was going to ask you a question. If you can just give an example of a tricky clause from previous investors. What do you mean by that?
Yeah, maybe this is very interesting situation, because it's in the fine print, in the articles of association, in the shareholders agreement, where it is possible that the previous investors have some kind of rights that you don't have. For example, for them to trigger the starting of the sales process, and you have to always to wait for them. Yeah, this is situation, or for them to decide whether to do something or not. And if you're investing after a VC round, or they have been previously, it's very, very likely that you see such things. That's what I'm saying. If it's also an experienced angel investor, they might have this. So you be aware of that, see what is allowed, what is not, how are the decisions being taken, is that a problem for you or not. That's also very much corresponding to the type of investor you want to be. If you want to be reactive, why bother about it? You're not going to go to board meetings anyway to take decisions. But if you would like to be, and you put in a lot of money and you would like to be kind of influential, you have to think about these things. Normally angels are the ones that not taking an active role on that thing, but at the same time you have to be aware of what is possible and what not. That's what I mean. It's case by case. So, but I just read we just had we are fund, and there are some angels. We are entering a situation where they have a lead investor who invests like 2 million. We're going to invest $500,000, and they're giving all the people that are investing less than 1 million to sign a separate shareholders agreement, where they call it mini shareholders agreement. They designed this for the sake of simplicity, because angels don't like to read what we read it, and we see that there is a situation where they can do something in terms of things that are important for us that we cannot. You were not?
Yeah, I was just going to echo what you said. It's not only basically just agreements and you believing and trusting the founders. Yeah, of course we have to trust them, but for example, us like a fund, we make them sign all these declarations that whatever they have declared, or whether they have loans or other things in written, that what they have declared is the truth, and if there's some misconduct or illicit activity, they have certain penalties. So this is quite often what we see as mentioned angels. Maybe it's not that they don't like to read long shareholder agreements, but probably they're not that experienced, or they don't think these things are important. But yeah, basically whatever the founders say, it's nice to have it written on a list of paper, signed, and
yeah, always. Yeah, in writing, I don't rely. People forget, they twist, they have wishful thinking. And just one thing about this that I don't want to forget is the first time you do it, or maybe always when you do it alongside some kind of a professional investor. So, but then the only thing you have to be careful about is your interest to be aligned with them. Let's say that you would like to invest with a fund, so they will do this job for you. But still you have to be aware that there are situations that they might ask for things for themselves, that they don't give it to you. Sometimes it's normal. It is normal when it is about prioritizing and making things faster and signing quicker. For example, like instead of 10 people with 5,000K to take decision and always kind of block any kind of process, just to say, okay, we don't ask you for this, we ask you only for the things that are important in a way. Then you have to see, because you have VCs that are probably gonna kind of, I don't want to use the word screw, but have privileges for them, but not for you. Our fund is not like this. Time for promotion. Our fund is designed to protect your interests on a pari passu level. So all the things that we have, we give them to you. This is kind of not always the case. So liquidation preferences, commercial terms, only taking the decisions on operational matters is a matter of if you invested as much as we have, you have the same things. But if you have like 5,000, we invested $500,000, probably you will be not there in this boardroom. So the board seat is not offered. So you have a question?
Yes, I have a question related to loans and that. The question, because you mentioned that you don't support paying off debts of the founders, but let's imagine that throughout the funding process there was a delay, and in order to keep the flights, the founders have taken up a loan.
Yeah.
So this case? Or how would generally VC look at this? Would the term sheet be honored if this was the delay, there was a delay, and they would be paying off this debt?
It's
Or they can back
case by case. Again, I just said that it's possible that we say, okay, we understand this, there is reason, and then we are okay for you to take this money back, because otherwise you have failed the company, close the shop. But if the round is, let's say, it's all about size matters here. If the round is 100K and they have to give back 100K to themselves, then I'll be stupid if I invest in this company. I don't care. I mean, then I'll look at another opportunity. Why would I give them 100K to take this 100K for them? What would be there in the company to develop this company? So you're shooting yourself in the leg. But if it's like a small amount, you can say, okay, you need the money instead of. Sometimes it's the trade-off is much more simpler. It's about the salary. Yeah? So they have not paid themselves any salary. Now but they are struggling. They need money for their family. You just sit down and discuss this with them. But again, you're not here. You're not charity. If you would like to be charity, that's fine. But you're not charity. So if you give them a lot of money just to pay themselves, you're not going to help the company that you will be owner of or part of shareholder. That it's case by case, but this is a principal position that I have on closing loans. Yeah.
So because you say that this is happening after the term sheet, so when you have signed the term sheet and you discover this threat, or it's after? So is this after?
We have probably here misplaced this. We started to talk about due diligence, and now, but normally term sheet is before that. But I told you can do due diligence before the term sheet, but it's not normal because of the practicalities. Normally, you do the term sheet and then you do the due diligence. But basically, what can be said here is that the term sheet should kind of reflect your position on things. And one of the positions that you might have is no money will go to cover any loans. You just put it in the term sheet, it's there. My advice is there are different kind of term sheets. In America and US, you have this one-pager term sheet, very simple, just how much money you invest, what is the price, and what are the conditions you might have for taking decisions. One-pager. In Europe, we have longer term sheets, and that's something I recommend because it kind of saves you a lot of effort and time afterwards. Once you have this template for this term sheet, it's not so difficult to write. And where you kind of address all these possible situations, which is pre-closing conditions, what is a post-closing conditions, pre-closing at these conditions that have to be done by the founder before they get the money. And if they want to get the money, they have to do them, like IP transfer, like covering the loans, could be anything. And post money could be, okay, transfer the developers in 6 months, maybe hire a CFO, do the reporting why, get a proper accounting company. A lot of things can happen after that. It's a way to not drag the process and to kill the company. Is to say, okay, all these things will happen in 6 months, in 12 months. But now, for example, we have a company that have agreed on such things with the investors 2 years ago. They still have not done it, but because we're doing due diligence again, we see this and we ask them, why didn't you do that? We didn't have time. The investor was not kind of persistent on that. Yeah, that's. But the term sheet is. What is a term sheet?
Just a second, because.
Yeah, I'm sorry. I had a question. Why is not planning a red flag? It was part of the.
It could be. If this is important for you as an investor, but I think it's kind of important because what does ZOP means is a stock options plan, which is kind of motivating more employees in the company, which gives you more stability in the future, like hypothetical stability. That is, if the CEO leaves the company or is not fit for the job, you have other people that are still doing something and they feel ownership in the company. And some investors say, okay, we need to have this for sure before we invest, or we need to have a plan for that. And if you don't see this, could be a red flag for you that this is a solo founder who is egoistical and that doesn't want to share back with the employees. But it could be the case that he forgot about it. He didn't knew how to do it, because this is also a new thing for this legislation. Yesterday there was a presentation by Ernst & Young about this. How I think that also BESCO is working on that. So we can have legal entities that can allow for that, for this kind of a job. But that's not what it meant. It might be not your priority, and in some situation you just agree with the founder, okay, you should do this, and you kind of follow up in 6 months. Because, I mean, your biggest leverage to influence the company once you transfer them the money, do you know what the biggest leverage is? That they will come back for more money later. So that they need to keep the relation with you. It's not like, okay, I took your money and then fuck off. So no, it's a kind of a very blunt and direct, but that's the way it is. So they have to have a good relation with you. So they also listen to you. Sometimes they don't, but most of the time they listen also to you, and they deliver the things that you agreed. Yeah.
Sorry, I have one more question on the diligence part. Based on your experience, what about the following scenario? We have one leading investor, which is one big VC, let's say, and 10 more business angels invested in some startup. And let's say the VC is paying for all the 2 external lawyer firms and eventually financial auditors, etc., is paying the entire procedure of due diligence. What about the results, the reporting? How the angels actually have access to the report?
After the deal, or the due diligence?
During the, actually after the due diligence results are already...
In my opinion, they should have full access to that. Otherwise, it's not transparent for all the co-investors during the round. Sometimes I know what you're talking about. They have some kind of VCs that don't share this, because you have this kind of weird situation where the company that they paid to do it, they don't want to share it because they cannot be accused for misleading or doing it in a bad way. I don't know, I'm not quite sure what was the right legal word, but the situation is the following. So we had one situation where we had to sign a document where we will not hold these lawyers from UK accountable, for that if things go wrong based on the data that they provided this kind of report. And in this situation, but normally when we do as a fund, when we do this, we would like to share this with all the co-investors so they can have the same data and they might decide not to invest, which is the fair way to do it. But this kind of practice is based on that kind of situation. In some kind of some countries, in some legislations, you have this situation where they would like not to share it because of that.
I think we're asking about sharing the costs.
Yeah.
No, he was asking about the report, but
I'm asking about the report and what's the best what the angels could do for their interest in this case. Probably to include some clause in the term sheet that if some of the other investors is doing some using internal or external resources for due diligence, to share all the reports with the other investors.
It is possible. That might be your condition. Just say, okay, I cannot do the due diligence myself. I just would. But costs are also important because sometimes the costs should be covered by all the investors. That means that the angel should pay this as well. Our fund doesn't ask you to pay anything, and you just kind of have a free ride on that. But that's kind of our positioning on the market. But you might have some that paid 20,000, 30,000 euro. You just have to pay it if you would like to have this kind of information. You just might say, okay, I'm not paying anything. I'll participate only if I get the report. And that's it. Maybe the founder will, normally it's on the shoulders of the founder because they have to go to the VC, say, okay, please share this thing with them because otherwise they will not invest. So there is not one rule. There are some good practices. Normally, I think it's okay to share everything with everybody because we have to be transparent. Why would I know a situation which is risky and not share it with you? I think it's I can think of some situation where that's the case, but that's not good business.
And I mean, when talking about the Bulgarian market, of course, yeah, we've been talking about investments between 25k up to 100k, but this is usually in Western Europe or maybe USA. But here in Bulgaria, most of the angel investors invest 5 to 10k euro max. And when you have a lead investor, sometimes it's easier for the lead investor just to top up the investment in order not to have angel investors into the round, because angel investors can complicate the whole procedure, the whole agreement, the way decisions are taken after the investment. So it's always nice to have angel investors, but you really should be able to provide to the lead investor what you're giving the company besides the money you're investing. And you need to have a good relationship with the investor so you can, deal with all these topics about the due diligence, whether you're going to share costs or not, about the due diligence, how you're going to construct the shareholder agreement, etc., etc. Because if there are, for example, 5 investors, 5 angels into the deal, and every angel wants or seeks different clauses into the shareholder agreement, it's a pain in the ass for the lead investor to accommodate for that. So keep that in mind as well.
I remember how it is called, this thing. It's called hold them harmless letter. You just sign this thing and they give you then the whatever. It could be an audit, it could be due diligence report, but it would be probably rare. I don't think that any fund from the local ecosystem, if would like to have angels, will kind of restrain this kind of information from you. So going back, draft sheet is very related to due diligence. In a way, it's addressing all the things that you should check after that. So you just say, okay, this is the thing, we agree on that. They start to argue here. You can negotiate because it's not always the price. But this is just to give you an idea what it looks like, a template. This is a template that was developed by DSP, the legal practice that we work with in the club. And we also work with them in the fund. We can send this to you so you can have it. You can check it out. But the important here is to see if you can to see how it looks and what are the importance. Probably I don't know if you see from there. I just wanted to show you a document, but we will give this to you. So we can go back to the presentation where you can see the important things. So what do you include in the term sheet? How much you're going to invest? Who are the other co-investors in the round or on the previous shareholders? What is the price? What is the valuation of the company? It could be said in a different way. It could be pre-money, post-money. I don't think we have explanation for that term. But pre-money is how much is the company cost before you put the whole round, the whole amount of investment. Post money is after that. If you invest in 100k in a company that costs 1 million, it's called 1 million pre-money. And if you would like to say it like post money, it costs 1,100,000 after you've given them the amount. But basically, it's simple. It is how much you would like to invest and what is the percentage that you get for that. That's it. Or number of shares. Liquidation preference. This is another thing. What is liquidation preference? Liquidation preference is who gets paid first if things go bad. Let's say the company has to it was evaluated at 1 million and you have invested 100,000 in the company, and then the company is being sold for 300,000. So if you have liquidation preference, there are different type of liquidation preference. You get paid first your 100,000, then the other investor that has this, and all the others that don't have it, they get nothing, including the founders. So this is a way to protect your interests from the bottom up when things go bad. It's a good thing. Sometimes angels have this, sometimes they don't. Yeah.
How things work when there are liquidation preferences and investment provided as convertible loan? How they compare? Because in general,
depends what you have agreed.
Creditor should have higher priority, but if there is liquidation preference signed with an investor.
Yeah, depends on what kind of cascade is being negotiated. And if it's a convertible loan, you might participate in this convertible loan and have a liquidation preference that you get paid first before the others. It's as simple as that. But if you have not agreed on that, maybe normally debt is before equity, and normally convertible loans are first. But there are ways to surpass this. Depends who you are and what you have agreed. But normally you have a cascade. Cascade is like this: who is the lead investor? They get paid first. Then you have other investors, and then you have the founders if anything has remained. Things become very complicated when you have double liquidation preference, participating or not participating. It becomes very, very complicated, but it's kind of important to think about it when there is. But we will get to convertible loans and what are the advantages and disadvantages for that. So conversion trigger is maturity date, next qualifying. This is for the convertible. If you're investing through convertible loan, for those that don't know what convertible loan is this is you give them money with the agreement that this money will be converted into shares upon a certain kind of date, or after 1 year or 2 years, or upon a kind of liquidation moment. And then it's a way not to discuss too much the valuation at the moment. It's the way to give them money, and of course this money has some interest. This is an instrument that we use for investing in companies alongside direct equity, which is kind of buying the shares immediately. So another thing is good to agree. Yeah.
Question about conversion of loan. What's the standard practice you follow? This convertible loan gets converted before the actual new financing, or at the same time with the new finances, or otherwise that is the converted loan diluted by the new investment or not?
It depends what normally the last investor sets the rule. So they might say, I will not invest if this is the case, or I will invest if... So normally it's at the same time. So you have a situation where you have like 50 or 60 convertible loans being signed, and they need to clarify this, and they say, okay, first you convert, and then we value the company, and then I will enter and get some kind of percentages. So it's again what you agree, but normally this is the best practice. Yeah. At the same time, yeah. So information rights, this is something that should also agree at the stage. That means that what kind of information and what kind of frequency do you require for you to know what's going on in the company? There are financial reports, there are management reports. These are things that are important for you to follow what's going on normally. Sometimes you don't have other platforms to understand what's happening. If you're an angel investor that is involved in a company, you might know, but sometimes you get all your info, especially when you have 20 companies from this kind of report. So it's good to plan this so you can really have a way to understand what's going on. Participation rights, okay, this is a good thing to negotiate. Is do you have the right to participate in the next round? If there is a next round, if things are going well for you, it's important to reserve the right to participate. Normally they will invite you anyway, but you might be a situation where the company is really hot, and this is the one you don't want to miss, where you need to negotiate that you be able to participate. Because if you don't participate in the next round and it's a huge valuation, you will get diluted a lot. And it's better for you, let's say that you have this plan for 20 companies, but you see that 1 or 2 are going very well, so don't do the 20 companies. Just go in these 1 or 2. You already kind of been lucky and you hit the jackpot. So this is very important to reserve capital and to have the right to do it. This could be negotiated in a term sheet. Founders vesting, what does it mean? It means that so a lot of founders, they say that they're going to work full-time or be in the company, and they don't. And you can say, if you leave the company, there are two scenarios, good liver, bad liver. Good liver is something, okay, I got sick, I have to leave. You say, okay, I still value your contribution, you have your own shares. Or maybe there is a situation where they just leave and work for a competitor, but they still have the shares. So it's good to agree that if you do this, you might lose all your shares, or you might lose some of them, and then a little bit more based on time. This is called vesting. We don't have time for this. This is an interesting situation which is have to be addressed. It's called vesting. So there are legal structures that have been developed to do this. It's elegant and it works to discipline the founders. Of course, if they want to screw you, they will screw you. But still, if you have this agreed and you're telling them that you will agree this in the main documentation, it's kind of a way to see if this founder thinks how they think about this. Closing date. This is something that is good to have. It's like, when are we going to close? Okay, we're going to close in 30 days, in 60 days. It almost never happens exactly as we've agreed, but it disciplines everybody in the round. Normally, this is something that the lead investor should say, so the angel investors are getting more disciplined and they really follow everything that is happening, and they send the documentation, they get through the KYC process, etc. How are we doing with time?
We have a little bit more time because the food is coming, so we can have 10, 15 minutes more. We have 2-3 slides more.
Okay, so we got into this convertible loan. There are basically two ways to structure a deal. What does it mean? It means that you can buy directly shares in the company, or you can get this convertible loan. Some people call it convertible note, some people call it, but at the end of the day, it's loan. I'll start with the loan because it's probably more weird. This is kind of a document where you are agreeing that you're going to get the shares later. When there is another liquidity round by a professional investor, the valuation is set, then you're going to get the shares. But now, for now, what we agree, I'm giving this amount of money, and we know that because I've risked earlier, you give me premium later. It's either a discount or it's valuation cap. Discount is like 20%, and valuation cap can be anything, what you agree upon, like no more than 5,000. Even the round later is 10 million, you still give me my shares based on 5 million price, which is because you've taken the risk earlier and you kind of supported the companies when they needed this kind of money. This convertible loan is faster. It doesn't have to be done at the same time with the all the signing of documents. Equity is the most straightforward. In Bulgaria, we normally invest in OD, limited company, or we invest in joint stock AD. So basically, you get shares for the company. So depending on the valuation, if it costs 1 million and you invested at 10 level, you get, and the company has 1 million shares, you get 10 shares. As simple as that. But it's slow, it takes months because you have to align everybody to sign and do at the same time. But it has clarity on valuation, you know how much you're getting exactly now. And it's kind of a cleaner way to do it in the long run. And there you have to be careful about what kind of stocks you get, preferred stocks or common stocks, which is another way to say who has privileges for these liquidation preferences and all the other rights you might have. So you have to look at that, what kind of stocks on the table. Normally the angels get common stocks if there are other professional investors at the same time. If you're the first, you can say, okay, I get preferential stock. And you demand it. There is on the convertible loan, you have this, you will hear it's called SAFE. It's the same thing, but it's simplified. It's a document developed by Y Combinator. Probably you've heard about Y Combinator, one of the most prominent early stage investors. They produced companies like Airbnb, Dropbox, etc. Really, really successful, and they've been famous for protecting founders' interests. Though they created this SAFE document, it's kind of standardized. It's for free on their website. I think we have it here in Bulgaria too, but it's not really protecting you as an investor. It's kind of faster and easier way to do it. It's a loan, but could be without a cap or without a discount. So in a way, it's good for everybody. But my advice is just use a convertible loan designed by a lawyer. They can protect your interests. But probably it's more likely for you to be given the type of instrument that is used in this round, so you have to evaluate it yourself. We have invested as a fund in one company through safe instrument because that's the way it was. It was Y Combinator, it was like 20 other investors, and either you take it or leave it. So we invested in 200,000 in a biotech company in UK. It is, but at the end of the day, it's kind of a convertible loan. That's what you need to remember now.
Maybe I just want to add something about the convertible loan. So it's quicker and easier to invest through a convertible note at the beginning, but then the conversion is a bit more difficult. It takes at least 3 months. Last time we had to convert a convertible loan, it took us 9 months because of the procedure that you have to go through. It costs money. It's pain in the ass.
Very complicated.
You mean in Bulgaria, right?
Yeah, in Bulgaria. Because most of us will be
You have
probably investing in
interest.
Bulgaria.
Interest.
Yeah, but if I can share from experience, what we did was we returned the amount that the shareholders were investing in the convertible loan, and we agreed on using the same cap. We just made a straight investment in equity. We just returned the loan with the interest. They get the money back in the bank, and it was just a straightforward transaction for 1 month only.
Mm-hmm.
Yeah, that's an option, but you know, there's certain loopholes there where you can, if the founder decides to screw you, they'll screw you. And yes. Yeah, but for example, us like being professional investors, we're not allowed to do these things. So for us as an
To do what?
For the company to return us the loan, and then we provide the investment.
Because you cannot do it. That's the
Yeah.
stupid thing here. That's you are an investor, but you cannot give loans. You have to be. This is a quasi kind of loan, but you have to also remember that there is an interest. According to Bulgarian legislation, you cannot give only loan. You have to give interest, and the
And you also
interest
have taxes.
has to be, it has taxes, and it has to be kind of market interest, not like artificial one, which means that it complicates things a lot, because when they return you the money so they can be converted at the same time, they have to be accounted for. Sometimes that's a problem for the founders, because for you it's good because you get a little bit more. But the founders might say, that's not what we have agreed. And that's happening just because the legislation requires it. So there are ways to calculate it, but it becomes a nightmare. So I don't know what to recommend, but sometimes convertible loan is much faster, and it's kind of keeps the conversation for the valuation, which is kind of a imaginary evaluation.
You have the cap. I mean, there's the conversation that's on the table.
You have the cap, but still, yeah, you're right. But you can be around without the cap.
Yeah.
Could be the discount.
Would you participate in such a round without the cap?
Depends. If it's something that we envision is going to happen very fast, and they just really need it as a bridge loan, you may be right. You still have the cap. Which is, how much money you're going to get this company when there is a next round.
And what if there is no next round?
It depends on the
loan, yeah.
predicament about that. Is it because the company has failed, or they have thrived because of huge success? And I think for everybody it's better that there is not another round, because they already made it. I mean, presuming that they have progressed, and they don't need more money nobody else is going to be diluted, because even if it's convertible loan, you get diluted.
Yeah.
And it's also, there are a lot of founders that come to me and say, okay, We can do it on our own, but then we're considering to get some funding. So if you can do it on your own, do it on your own. I mean, don't get investors on your back. We will demand things and we will be asking for something. But of course, they know that they can, even if they can do it on their own, they will do it slower, which is important. If you do something, now we have a company that they opened in Bulgaria, they're successful here, and their plan was to open in Romania. And they are dragging the process for some reasons, not only because of them, because of other investors, and they have not entered on this market. And during this 1 year of negotiation of other investors, whether to invest or not, we discovered that there is already a competitor there. So it matters. I mean, I think that the biggest advantage startups have is the speed, the way they do things compared to big organization. If they don't do these things fast, they have nothing to compete with. Maybe the innovation, but the innovation is possible to copy it very, very quickly. All the software cannot be patented. They can. The only protection you have there is how complicated it is, how much time do they need to write it down.
But I have a question regarding the speed. What I've seen in Bulgaria is that investments happen very slowly due to the structure funds here.
Because of the funds. That's true.
And angels usually invest with funds, and there are advantages and disadvantages. How we can change this? Because we have deals in the club that take 6 months and even a year.
I mean, who are we? The club? The angels?
The angels in the club.
You cannot change this. I mean, you cannot change the procedures of the funds.
Yeah.
You just have to either participate in this or not. You can, as an angel, you can decide to invest on your own only and just gather. There are some angels that have the financial power of a fund, and they do this themselves, and they do it faster and quicker. That's a very big advantage. I mean, comparing angels with funds. Angels can be faster if they don't want to do it on their own. Yeah, but most of the time the rounds are very big and they need the money from the venture capital. But I don't think that angels can do anything about it, or we as a club can change the situation. I mean, maybe the only thing that we can do is to partner with funds that are faster, that are probably from other locations. But then, do we have enough interesting opportunities for them? I don't know. Maybe not.
What about the opportunity, some of the angels to be like bridge investors? Let's say the startup will get the money in 6 months, and some of the angels will give money now with convertibles.
It's a good opportunity sometimes, because you could get the same terms as the last round before the new round opens. That's a very common scenario. So if you're an angel and they just need, we have such a situation now where they are planning to raise a lot of money, but in the meantime they need some more money to get to that moment. But again, that's also very risky, because they might not reach that stage and you will lose your money. So it's a trade-off, but it's a way to get on a better valuation later. You will see a lot of founders coming to you and say, okay, now we're going to raise a Series A round. We're going to raise it at a 20 million valuation. We need 5 million. And in 1 year, you see them, what happened? They raised nothing. But they were not willing to drop the valuation. So in the meantime, what happened, I don't know. But that sometimes you can, if you still believe in the company, you can use this and just get a better price. As simple as that.
Give an example of the condition that you can put in the final document after finding some red flags or something that you found during your diligence process. You said that you can give us an example.
Okay. So you have this pre-closing condition and post-closing condition. The pre-closing can be, even if you sign the final, the condition of the transaction is for them to finish the QAC process. Maybe we don't want to drag before it's finished. So this is something that could be there. It could be to hire a CFO. Could be hire a CFO. It could be to improve their financial plan. It could be that they draft that they make all the contracts with the employees in the right way, because they don't have the IP protection clause. As we've done this, there was one company that was based in Prague, but they have their main company that is fundraising that is based in London. So there were, in the due diligence, there were a lot of red flags about transfer pricing. That means the following, that this company has a risk if it's audited by UK legal authority to say, okay, you're doing things in the wrong way, we're going to tax you. So I don't want to go into details, but then we said, okay, if you want the money, you have to do this before. But then there was another investor, this will take a lot of time, so they have to sign now that they will do it after. This to fix this, what it means to fix it, to hire a consultant, to do all the documentation the right way. So if they eventually have ever a check by the UK Revenue Authority, they show them, and everybody is fine with that. Because they don't, if we enter in a company where they risk a very big fine because of that, we might lose all our money. So things like this. So it's about addressing the most important things before the transaction, and some of the things that they're kind of also in the interest of the founder to do this. That's my thinking. If there are things that are not in interest in the founder to do them, but are in my interest, I would like them to be completed before the transaction. If they're in everybody's interest, they will do this anyway because it's their company. They have the biggest share and they believe in this company, and we believe that they believe. So we kind of expect them to be diligent enough, prudent enough, so they do it. Sometimes they don't do it because they were prioritizing other things. They forgot, or they suddenly decided that it's not important. Sometimes they are right, because you have investors demanding different type of things, and they have to prioritize. Okay, so the next session is, and the last one, is about what happens after we have invested. Although some of the things that are actually happening, you should have negotiated before or agreed to kind of set the foundation of. And this is the things you should think about before, but actually they will materialize after you have already invested. Is first, having negotiated and wanted to be part of the board. And this is different from being just an advisor. It's more formal, it's more demanding. You should be actually going to even the legal documentation sometimes. You can agree on that informally, but normally you need to be part of the board. And it is normally at this stage non-paid, non-executive role, which in addition to your advisory, because being part of the board, you're also advisor, but you have also decision-making function. So it's something that normally angels don't do, but it depends. Sometimes that's exactly what they are asked to be part of. And being part of the board is something you should consider. Probably when you have more time, when you're more involved, your stake is bigger, you've invested more money, and you're also expert in the domain. Because if you are knowledgeable in what exactly the company is doing, it kind of makes sense for you to be part of the board. So in a way, also you have to take decision what kind of angel you should be, what kind of investor you should be. Are you going to be only advising when they ask you, or are you going to be kind of also controlling what's happening in the company? It's good to put some kind of boundaries of what the decision should be in terms of founders deciding how to spend money, who to hire, who to fire. Of course, you don't want to invest in a company where where you have to manage it, because this is not angel investing anymore. Maybe you do, but okay, if you're an angel investor, you expect the founders to do these things, but you can help them, but you can also control them. and it's good to have some things that are associated with the type of spending that they can do, and the type of changing of the core of the business. Sometimes that's required, but it's good for you to have some kind of control on that. When things go bad, you need to be able to say no. You need to be able to stop some things, which is also something you should have negotiated before. But that's what happens. Sometimes you have not negotiated this in terms of documentation, but you can control this if you have more hands-on approach, if you have the right information, if you're involved. Just to give an idea of all the aspects of your potential role, that could be the reality. But most importantly, as an angel, it's kind of expecting for you to add value. Add value in different. You can do it in different possible ways. But at the end of the day, the founders are coming to you not only for money, but for your expertise, your knowledge, your network, and your motivation to help them. So think about this before, and then try to multiply the value of your investment by doing that, by adding value to the company. And no, we're not going to it again. So these are the things that you can possibly do. These are not exhaustive lists, but it's something that what is kind of possible. Of course, you can refer them customers. That's one of the most valuable things. Is if they are in a B2B business and you're executive coming from an industry, you should know more people than they do, so you can help them, referring them customers if this is relevant. Sometimes you can do this out on the back of your existing network. Sometimes you can be proactive because you're more senior, you're an investor, people pay more attention to you rather than a young girl or boy that nobody knows and nobody trusts yet. So the other thing is help them with social media. Just retweet, repost the events that they organize, the product that they are launching, the web page that they have, and of course suggest ideas. This is something that is kind of a tricky, because sometimes you can suggest ideas without being asked. Sometimes they will just be very, very active on asking you things, and you will get even annoyed from that. But it is also something that you should negotiate up front, because you have some angels that would like to contribute, they like to get involved, so they should first discover the person that is ready to offer that, and secondly to agree on the type of interaction that they should have. And if you are that type of angel that doesn't have time and doesn't want to do that, just say, okay, don't expect anything else from me, here's the money, I don't have time for that, maybe I'll help you, maybe I don't. Because you have sometimes founders that are grudgy and really bitter about angels not helping them enough. That's why they failed. So you have this situation. So other things that are possible, of course, is to follow competitors and to share the information with them about this. The more people care about business, the larger the network that is actually being in a position to help them. And here we have this moral support. This is very important because things get tough. After a while, you will see founders that want to give up. You have to be there to support them if this is necessary, because they have survived, they have suffered a lot, and they have, I mean, normally if you're a founder of a startup company, you don't have a lot of money as a salary. You have a family, so after 2-3 years, if they don't really start to flourish, they might be in a position that they would like to give up and don't know what to do. So it's kind of really important to have an emotional senior person that can hold their hand for a while. Yeah, all these things that I listed here are possible, but you can design your own. But there are a lot of things you can do if you want. Some angels start to work for the company. Sometimes they want payment, sometimes they don't want payment. normally the ones that they don't want payment are the ones that actually entered into this game just not to get a return, but because they have free time, they have retired, and they just wanna help a younger person to succeed. And these are the not exhaustive lists. Once again, you can think about, and once you invest, try them out, see how it works, negotiate this upfront with the founder, and just open the door and say, okay, let's work together. So this slide kind of want to give you an idea about the volume of work that could actually happen if you want to be more professional and if you want to really develop a portfolio over time. And the portfolio management is more difficult, as we said, than the portfolio creation, because it has first the volume become, when you invest in one deal, you focus on that deal, but after that, after a while, you have like 20 or 10 companies, and all of them have various problems. Your involvement might be, of course, different in the different kind of companies. In some of them you might do nothing, in some of them you can be a partner, an active non-executive partner, and this is up to you, but at the end of the day it is important to understand what you can expect. You can have issues with reporting. Most of the founders don't report frequently and regularly, even if you agree with them. Sometimes we say, okay, you should put a penalty for that, but that's not really something, again, you want, because you have to penalize a company that is barely surviving. So this is not always the right solution. On the other hand, if you don't know what's going on, that's a difficult issue to ask if they don't share what to do, apart from only reminding them, why don't you share, why don't you report, why don't you report? So if you're part of the board, you will see a lot of politics there, you will see other investors, you will see friends of the founders. Sometimes it is something not so popular here, but I mean here, what I say here is in Bulgaria. We've seen it mostly in the movies. I'm still myself gaining experience in this direction, becoming part of the board. So, but I see in the boards not only business sense, I see politics. That's what you should prepare. And of course the dramas with the founders and everything that will happen when the companies will start to fail. So there will be a lot of failures, so you have to be prepared mentally for that and to expect them. Yes, I don't know, everybody handles this differently, but it's not a pleasant experience. Someone to call you and say, okay, we're going to be out of money in 6 months, or maybe in 1 week. This has happened, and you need to give me money, otherwise I'm closing shop. That's a very, very tricky situation. What to do? I don't have an answer for that. It's case by case. But one success story can change everything. Yeah, well, once you have a company which you manage to exit, and if it's a good exit, it kind of re-energizes everybody to carry on and do this more. This is just a scenario to show you why you should build a portfolio, and why having a gazelle matters. The way to read this is the following. The first scenario is you have a portfolio with companies that have 1x, 10x, and you don't have a 100x return. You have this scenario 2 and scenario 3, where you have this company with this huge return, and this MOIC is a multiple of invested capital. It's basically how much money you got back on your capital, and you can see basically the difference in terms of if you have company that actually have a gazelles, as companies that are really venture case companies, can make difference to your portfolio. Just to visualize it. So what I can say here is that for you and for me as a early stage investor, for us, it is more important not to miss the right opportunity rather than just to screen out the bad ones. Do you understand this? It's like that's why making more bets mathematically at the end of the day is good for you. So instead of being the most careful and diligent investor, which you cannot be because that's not your full-time job, just try not to miss the good ones. Which you don't know, that means that it's safer to make more bets rather than just to make a fewer ones and just screen out the bad ones. More times you will be right by saying no, but if you miss that one unicorn gazelle, then you will not make money. So how are you going to make money? By selling the company. So this we call exit, and you have shares, and after 5-7 years, if you're lucky, someone comes and tells you, I want to buy your company. Probably it's not in this kind of a pattern. It's more likely that all the investors hire a consultant and they sell the company proactively to someone. And we will see what kind of type of buyers can be there on the market. But basically, you need to understand that this is a long-term game. It takes 5 to 7 years. I don't think it's even 5-7 years anymore. Sometimes it's 10, 12 years, even from the funds, because you are entering very early. That's important. You are entering like at the moment of creation of the company, at the moment when the product market fit is designed, or maybe a little bit later, but it's kind of in the first 1 or 2 years of the existence of the company. And until it reaches a point when it's break even and it's scaling up and someone wants to buy it, it just takes time. As simple as that. If you're lucky, I've seen investors going into a deal later and then exiting in 1 or 2 years, but that's luck. That's not by design, because you might go to deals at a later stage, but they will be a lot more expensive, and probably your money will be not enough to participate in that round. Of course, then you can make, there are some angel platforms so that actually pool huge amount of money, like in the range of 5 million to 6 million from angels, and they participate in Series B, D, where they are just about to IPO, but that's very rare. We don't offer that. On the other hand, now we have B. Maybe we would like to think of some kind of instrument for that, but we're not that yet there. But it takes time. So at the same time, be aware of your liquidity, how much you're gonna have, how much money you have now, and how much money you're gonna have in 1 or 2 years for this thing in particular. Of course, our advice is not to invest your last money on that, and you would not probably do that. But still, it is important to reserve capital for follow-ons and to be patient. So in another way to say it is like, okay, you invest this money and you forget about them in terms of expectations that you will need them and use them. Of course, you're not forgetting the investment, because you need to help this investor, you need to control, but not like, okay, I'm going to have this money in 1 year if I need it. No, you're not going to have them if you need them, not this particular money. So this is the right way to think about it. Yeah.
Should angels exit during later stages of the fundraising, or it's not recommended, or?
If you can, the price is good. Why not? Okay. I told the story to you, I think the other day. There was one angel that invested in one company. It's called Limplum. There were a lot of angels actually that invested at the beginning. And when they had a series of rounds after the angel round, one of the rounds, there was a very big investor that offered to buy all the angels in the round, because they didn't want to bother with all these small angels. So he decided to sell his shares, and he got his money 7 times back on that round particular. But one of the other angels decided not to sell. And when the company later was valued, it was valued even more. But then I think that he didn't sell even on the next round, or maybe it was, I'm not quite sure of the story, but recently Limplum was acquired. So but I don't think the valuation was that great as they expected it to be. But anyway, it's a good success story at the end of the day. So you have normally it's more rare that you have an investor that would like to buy the existing investors, but in later rounds, if the company is doing real well, it is possible. But then it's, if you trust in the company, if you think it's going to reach your IPO or better valuation, just keep it. There's not a rule here.
And another question regarding the follow-ups. Because what I've read is the good practice is to dedicate specific amount of money for investments at the beginning before you start building your portfolio, and then decide a percentage out of this money to go to follow-ups.
Yeah.
Do you have some number or percentage?
50%.
50%.
Yeah.
Isn't that too much?
But think about it: is the later the company is, the more money you need to keep your share. If it goes well, if it doesn't go well, you don't do the follow-ups anyway. In our fund, we've allocated like 50% to invest first time, and in the winners, our model is like invest in 25 companies. And in the model that we presented to our investors and the way we think about it, in the half of the money to invest in follow-on in, let's say, 7-8 companies. So we can keep the share as percentage and then make money eventually out of this. But again, it's up to you. You have some. I've heard this kind of thinking that there are investors that invest only one time in as many companies as possible. Like 100 of them. Yeah, yes, it's a different strategy. So what are the exit strategies? What I mean by this slide is that sometimes you just join the ride and just wait for the driver to reach to some kind of destination. These are normally the VCs that actually push the deals, and you can exit alongside with them. Normally you will have this kind of clauses, drag along, tag along, which means basically that if they start to sell the company, if they won't, you have to sell anyway. Because normally when a buyer comes, they don't want to buy only some of the investors and the other to stay. Normally they would like to buy everybody out. But probably normally you would not mind to do this. If you are the only investor and maybe if a few angels together invested in a company, we recommend that you hire a consultant to do this job for you instead of asking the founder to do it, because the founder needs to run the business, they need to sell, otherwise the company will go nowhere. Let's say if it's going well, but maybe you have a scenario where it's not going very well, you just want to save your investment in a way and just get out with something, at least something, then you need to hire a consultant to work for you and just to find you a buyer, and just the founder will have a new investor or a new partner. And it is very actually common that the CEO, the founders of the company, the management just buy you out. Not an external strategic investor. You have a situation where they don't want to sell it. They would like to run this business as a lifestyle business, so something that they enjoy, that they would like to carry on doing, not to sell to anybody else. Then you say, okay, you can buy me out. And maybe you have this in the contracts even when you invest. What is the scenario for that? What is the minimum amount that you require? There are normally clauses in the contracts where you say that the right of first refusal is normally you have to offer your shares to the other investors or to the founders first, and if they don't want to buy it, then you can sell it to somebody else. This is a very normal clause and it's okay, but of course if the founders don't have the money to buy you out, maybe somebody else will have them. But what I mean is that it's possible to consider that you make money from the founders. So invest now 100K, and then you tell them, I don't want anything else. I just want that you give me 2 times my money in 1 year. That's as simple as that. No questions asked. It's up to you what you do. So in 1 year, the company is going well. They give you 200K. You're happy. Everybody's happy. So I've heard stories here like this. They're okay, and they just finance it from sales. Okay.
I have a question
Yeah.
also regarding the exits. I see that during most pitching events, the entrepreneurs, they actually don't speak about exits because the stage of the company is the early stage company. At the same time, on the other side, I've heard that all entrepreneurs should speak about exit opportunities. What do you think the angel should do when exit comes up? Should they address the question at the beginning, right after the pitching, during first meetings, or
During first meeting, if they have not mentioned it on the pitching, you should address it. What they think about it at least. Do they have really plans for that? At least that. They might have no idea at this stage who is the buyer, but at least are you aligned in this direction? No, we're not going to sell. We just want your money and we'll be investor forever. But maybe that's what you want at the same time. Let's take this company, Ancestral Foods. Ancestral Foods, I think that Živko, it's okay to run this for life. Yeah, with this one of the things that which is fine, but we need to understand if he's fine that we're gonna be proactive to search for someone to buy us out. So you have to know this thing. And that's the thing I can now comment. If they know who are the potential buyers, and if the answer is not artificial, like learned by heart, because after few pitching, the founders know what to answer, but the answer doesn't mean anything. The more specific it is, the better it is. Let's say strategic buyer. What is a strategic buyer? Can you give us examples? What type of buyers can them be? Is it like someone along the supply chain? Is it a competitor? Is it a dinosaur company that needs to innovate? So these are the type of conversation that you have on your first meeting with them. If they are not, if you want, you can ask them during the pitching, but that's a more logistical question rather than what to do at all. But yeah, this is more about the intention of the founder rather than a specific scenario that's going to materialize. You as an investor should know already when you see a company who you can sell it to. I think it's more about the angel to know about it rather than the founder. And the founder just have to agree that this will happen and he will not be a bottleneck. Okay, this is about the exit, what we can say, and we have a part that is addressing the biggest startup ecosystem players, so you can know to orient yourself, who you can work with, where you are. We told you we are the only angel club that is organized like this. But we are also part of a larger network. We are member of the Bulgarian Venture Capital Association that actually is organizing all the funds, and we are also there. BESCO is a Bulgarian Startup Association. Both organizations doing good work in terms of legislative work and promoting the industry and the players. So we have representatives as stakeholders in the places that we need them in governments, in events, etc. And ABLE is accelerator.
It's an association of entrepreneurs and leaders.
Okay.
But they have an accelerator program.
Yeah, that's.
ABLE Activator.
And you have all these accelerators that actually feed up the ecosystem. You have these guys ABLE, you have Founders Institute, you have new accelerators like Future Verticals. For food tech, yeah. You have these guys from Beyond. Beyond is green tech, I think, yeah.
Yeah, they have 3 verticals.
I think we have like 10 accelerators. You can join some of them as mentors, as jury members. They're very open for guys like you, where you can scout for interesting startups. They are a really important part. They're a new phenomenon, bless you, in the world, but I think that this is more evolving into the direction that rather than to have generic accelerators like Founders Institute and let's say Y Combinator, to have specializing in a vertical. I think this makes more sense. Now you have some even a trend where a specific city would like to open an accelerator, which is very weird. I've been approached by guys from Plovdiv and from Burgas, from the municipality, and they come to me and say, we have a very big building, let's make an accelerator. So, what are we going to fill in this accelerator with? That's the thing is, I told them, Plovdiv, you need to do accelerator for manufacturing, and in Burgas for tourism. Then you can build around this with the right mentors, with the right connections to the potential customers, and you will finally find some startups that make sense to this. But I mean, this is on a country level, but in Europe you have a lot of accelerators. So sometimes it's a good idea to tell the founders, you're not ready, go in an accelerator. Sometimes in an accelerator they give them free money. In Poland you get 50K just to go there, to show up and to register a Polish company. It looks like why wouldn't you do it, but still 3-4 months of your life for 50K to go there and to pretend you're Polish.
Another opportunity is e-residency from Estonia. Actually, the guy is coming at the end of June, and they have an amazing program for Bulgarian companies which want to register in Estonia. They have access to funding, and I don't want to promote this for Bulgarian companies to go build their business or at least register in Estonia, but it might be a good opportunity for startups. And they're very active, and it's a government program.
What I would recommend is that if you're interested in the company, in the team, but they're not ready for you, or maybe you've invested in them, because sometimes it's the other way around. You are the first investor, then it's an accelerator. You don't have to think black and white. But normally they would be not ready, and you would tell them, okay, let's go in the accelerator and work a little bit more on your idea so you can make it a business and you can make the right connection and validate the model. Then I would recommend them to go in a specialized on the market that you're eventually planning to land, like Germany. The way it's a big market. Well, you go to US, go to UK. You have a lot of good accelerators there. They have different models. Most of the accelerators make money from giving you money and asking this money back. As weird as it sounds, it's the following. I give you 30K and you give me 5% of your company, but out of this 30K, I would like you to come to my co-working and pay me 10K for the renting the space, and I providing you the training program. It is like this. So Accelerate is a good stakeholder and potential partner that you're gonna meet in our ecosystem and other ecosystems, and of course the venture capital funds. In Bulgaria, we have a lot of those. I'll show you a slide later on, which are active. Now, at the moment, some of them are finishing their mandates, their investment horizons, like Innovation Capital, Javor was from that one, Vitusha, all these from the funds are finishing, but they're going to raise new funds. So, and of course, you have funds like ours, but you're going to eventually work with all of them. Not all of them, but with some of them. Venture capitalists are the necessary evil. They'll have more money than you do. But you saw on the slide that collectively, maybe all the angels in Bulgaria, if they realize their potential, they might have more money than. If we, of course, as an educator on the market, manage to inspire them all, we might be comparative to that. But in Bulgaria, we're not yet there. So, but venture capitals are someone that you should consider. And government and law, at the moment there is no legislation that actually defines what is angel investor. We are thinking about doing something in that direction. At the moment I'm a little bit hesitant whether to see if we want to have accreditation for angels. From one side is good because it's kind of creating standards, it's defining good practices, and it's protecting the market from scams. On the other, it's kind of limiting, putting another bureaucracy, administration, I don't know, which is the good thing, but we're gonna kind of create a group where we start to work on that, alongside creating, which is very important, an angel incentive program, which is similar to the one they have throughout the world. One of the most prominent is in the UK, CIS. There is another one in Germany, is one in Portugal that worked very well. Once this program has been created, a lot of people became angel investors and invested a lot of money. What are these programs doing? They're sharing the risk, decreasing the risk for you to become angel investor. In UK is the following model. If you invest, I forgot the exact number, but let's say 100K in a startup, you have the right for tax relief. So if you, instead of paying this 100K in taxes, you get 50% of this money back. This is one way. In Germany, I think it's a complete grant. It means the following, that if I invest in a startup, then I invest 100K, this kind of authority gives me half of the money back. And I think in UK it was also the following. It has if the company bankrupts and you lose your money, they give you the money back. So things like this that actually decrease your risk tremendously. Why not have them here? It's going to be difficult. There are some things that we started to initiate. Actually, these organizations, BVCA, the Bulgarian Venture Capital Association, and BESCO are doing the heavy lifting now, but I have an idea to unite them because I think that they are doing similar things, but nobody knows what the other organization is doing. So we are not an association. We don't want to be an NGO, but still we have to get involved so we can create this because it's good for everybody. You're going to have your money back, so you're going to invest more, and we're going to have more members and more activities going on. If this happens, it will be good. There are some programs that are already making any kind of ecosystem thrive. Why not copy this model here? I'm just sharing this with you so you can, if you want to get involved and you have some contacts and any ideas in this direction, so this is open for everybody. We are really thinking to make a working group around this so we can, at the end of the day, what should be done? It should be a kind of some kind of draft law project that it should be goes in the parliament once we have a working parliament. So this can be voted and it could be applied. There is some initial feedback from the authorities, but you know, governments are changing all the time. We don't have government, so it's probably take more time than feasible, but we'll try it. So
there is also the media as a member of the startup ecosystem.
The media.
Yeah.
Sure, you're right. As a
For
representative.
the final presentation, I will include Endeavor, Innovation Capital, the recursive. Yeah.
No, you're right. I mean, we forgot to put this here because the media is playing recursive, in particular, a very important role about promoting the startups, the investors. So other ecosystems know about what is going here and enlarging the pie for everybody. Because at the end of the day, I'm talking about the Bulgarian startup ecosystem because it's kind of more relevant. But we are part. Look. I mean, this slide, we are part of a bigger thing. Now everything is open. We are part of the EU startup ecosystem, and investors from all over the world are actually investing here. And our region is growing faster than the others because we start from a lower base, but still it's something that we can show off. Look at these numbers. This is the I think the multiple that the companies have achieved since for 10 years. In terms of value, we are like almost 50x compared to the other regions. So our region is growing fast, and we are, I think, probably one of the best ecosystem in Eastern Europe. Really, I mean. In comparative markets, we don't have as many unicorns as Romania, but we still do have unicorns, and we have potential for more. And this is slides from the Bulgarian Venture Capital Association. This is the growth that we can show compared to other players on the market. So we are. I think that in terms of number of funds and in terms of opportunities, we are even better than Greece. And especially, for sure, we are much better than Northern Greece, where we're going next week in Thessaloniki. Athens has managed to attract some good amount of money in terms of venture capital in the last few years. Probably it's going to result later on, but still, you can see that we are not separate island. We are plugged in a bigger picture. You see, Bulgaria leads in number of locally based funds in number. That's a good slide. You see the names here. Maybe some of them you know them, some of them you don't. Some of them are current members, some of them are previous members. I mean the funds. I think.
I have a question.
Yeah.
From your perspective, is there enough high-quality startups in Bulgaria right now to satisfy this supply of capital?
It's a chicken and the egg question, but maybe no. But capital should create more opportunities. Maybe not in the way that we expect them to be created. I mean, like, okay, you invest in the company, this company becomes interesting. No, they invest in the founders that will be the future, the founders of future companies that will, basically the success rate is the following, that's statistics. Like the founder normally succeeds on the 3.4 time, but you cannot skip the first 3 failures. Yeah, you need to go through that, and that's the type of thing we're creating with this ecosystem. But maybe for a while on the market, for seed level, there was more capital than good companies. That's my opinion. From these companies, we had actually Black Peak was one of the partners was a member. We have now current members from NV3, obviously SAF, that's my fund. 11 is our current member. Innovation Capital. Now we just had a meeting with a guy from the BBR. They want to become a member. Morningside were a member. Launch Hub. Some of them didn't continue their membership. They don't have time, but still, yeah, we know each other very well and we play with them very well. So this is the slide for the ecosystem, maybe where this is taken from the BVC again, where you have this community, education, corporate funding. I don't know if media is here again, but I think that they are there. Yeah.
We're here. I'm happy.
Yeah. Okay, this is another slide for you to see the local funds and the number, the amount of money that they invest and the stage where they are. This is an important thing, especially for founders, not to waste their time and the funds managers' time going to funds which are not relevant for them. And you can see here that every fund has their own positioning. Of course, we overlap a lot, but still, it's good to have a navigation map when you start to fundraise, or maybe when you start to search for funding for your portfolio companies when the right time comes. These are some tips here you have for 10 experienced angel practices. So you can basically what a good angel can do. They can generate good quality deals. They do good information digging and select for home run. This is thing potential with moderated downside. They always negotiate good investments. We didn't have a lot of time for negotiation here, but definitely negotiation is part of the thing. Don't take things for granted. Try to negotiate. The founders are flexible for that. Probably you are in the position of power, not them. And aim for the high value, high return companies which are actually going to pay you all the bills. You don't want to skip. Don't want to miss actually the good ones, rather than just evaluate the bad ones only. Try to reserve capital on follow-on rounds. I told you about this. Add value through your proactivity and your network. This will pay off. And yeah, it's, assist the founders later in other rounds of funding, so you can start to create your own network of investors. At the moment, you are an investor, they are an investor. They will accept you as a peer. So, and then there will be times where your support will be required by your portfolio companies. It's good to start early, ahead of the cycle, and mentally be prepared that you will lose a lot of, not a lot of, but let's say most of the cases that there will be failures, and try to build your brand by mentoring, teaching, giving back, helping the founders for free. These are common mistakes for novice angels, which we've prepared here. Is like they invest in the first deal that they see, or like every second one. You don't rush. You have choice. You have time. Being part of the network will help you. Due diligence pays off. Sometimes it's very difficult to do it at your scale, but there is actually a research that the angel networks and angels that have done due diligence properly have like 2-3 times higher return than the ones that didn't. Try to define a domain of expertise, or at least interest, and staying there. I mean, when you build your strategy, remember about that. Don't accept high valuations. There is a hype, so probably it's better not to participate in overhyped companies. Most of the times you'll be right. Try to negotiate. The moment is very good at the moment for you to get better deals. Don't miss this. So again, investing in fewer deals is the other thing that we talked about. Build a larger portfolio. Create a plan for, maybe for some of you, it's your, let's say, exploratory year. If you're gonna carry on after this year, just try to follow this plan. Otherwise, you just have to accept that this is like an entertainment hobby, and don't expect a return. But if you want a return, make a plan to make a portfolio. I mean, how big, I don't know, but the statistics say that should be 15 to 20 companies. Patience, long term, we talked about this. It's something that would take 7-8 years at least. Dragging the investment process unnecessarily, this is also a good point. We've seen angels sometimes not taking decisions or becoming too much detail focused, and just asking for things that are not really necessary. If you feel like you're doing that, probably just say, okay, I'm not going to invest, so don't stop everybody else to progress if they're waiting for you. Yeah, these are pretty much the most important things about and mistakes that you might see in you or colleagues of yours. And do we have time for that? No. What time is it now?
15 to 2.
No, but so what we're gonna do is we're gonna leave time for Q&A for 15 minutes, so you can ask specific things and that are of interest to you. It's pretty much this the information that we wanted to share with you. Sure that we left a lot out, but that was the idea. These are the credits that we want to give for making this presentation and summarizing this knowledge. Jason Kalakanes is the guy that gave us the right to translate this and publish this book. David Rose is another guy that I've met also a long time ago, and he wrote a couple of good books about this. He's also the owner of Gust. This is the platform that we use in the club. The BVCA association, which is organizing all the investors in Bulgaria. ESIL is another organization that is providing trainings for angels and angel networks. The one what we wanted to bring here, maybe we'll bring them at some stage. IBAN, a European Business Angels Network that we are a member of, which are organizing congresses, events, they're providing resources to angels. Depot Ventures are friends of ours, very good, active syndicate of angels. They act like a fund, but they give the opportunity for the angels to invest in their fund, which are based in Prague, but they invest all over Europe. We're going to probably have a couple of deals co-investing with them very soon to announce, and we are thinking of inviting them over. They organize also similar trainings where we kind of borrowed some of the things to share with you. Yeah, this is it. So yeah, we open to questions.
Yes, we have some gifts books for people that are not part of the club, because you already should have ones, but for other guests you have a book. Okay, Ilan has a question.
One question in regards with return on the investment done as an angel investor. What is your opinion about possibility for success, whether to invest alone, build your own portfolio of companies over a long period of time, or participate in some sort of a vehicle like my fund one that we have the CEO Angels Club, where the common knowledge is shared, many companies are invested in with the money that is collected. So what is a better vehicle, so to say, in terms of investments?
It's again depends on the type of investor you want to be. If you want to participate in this syndicate, you kind of expected that you're less active because most of the work is done collectively. Maybe you can be very proactive there, I don't know, but it's probably, you're probably not going to be. If you do your own portfolio, then you have to realize you need to spend more time and a lot more money to make this big portfolio. So I would suggest that you can even decide to do both if you want. Depends on your disposable income and the thing that the budget you've allocated at the end of the day. But again, it's more connected to the type of investor you want to be rather than on the potential return. Because in the syndicate, you will end up again with some portfolio, and you can always mimic this portfolio if you want. It's available in the club. What I'm saying is there are some people that have this strategy. They don't take the decision to invest in a certain company. They follow a leader in the investment domain. You've seen this. Even though you have these apps for following stock investors in stock, you just do what Mr. Hicks has done. You can do this for the KDA. Whatever they invest in, you just invest on the side. But at the end of the day, if you want to, but you have the freedom to invest in something else that the KDA has not decided to invest in, because there you have the majority. They take decisions to invest with the majority. So it's not a black and white answer. It's up to you.
It's a strategy.
It's a strategy. Yeah, it's good to think about the strategy. Make one, change it. Don't worry. But you just have something that will just decrease the amount of time you spend on hesitating. Okay? When there's Naval Ravikant. Have you heard of it? The founder of AngelList. Just follow him on Twitter or buy his book or watch some videos. He's a brilliant investor. It was a rule that when you don't know what the answer is no. So it's all these type of rules that might help you to move fast and take decisions. Other questions?
It might not be a question.
But it might be feedback.
Yeah, some notes, something that you want to learn more, or something that you're interested further.
Are we going to receive the presentation?
Yes, I'm going to send it to you.
And do you... Yeah, go ahead.
One suggestion, it would be really interesting to have kind of a workshop where all these type of strategies are decided in a real case, where you get with money and to try to exercise all these things and to see also other angels, how they think, what is the strategy. Because if you talk about the wisdom of the like leveraging the amount of experience that is in the club, this could be an interesting type of a workshop.
That's
This is just
a
suggestion.
good
I
idea.
don't
Yeah,
say that
like a workshop on building a strategy. So only on that, so you can end up with something practical.
exercise in practice. Yes.
Yeah, it's a good idea for a workshop. We actually wanted to do something else, like in the vein of a workshop to show a startup, so you can start to comment whether to invest or not, and why you're not willing to invest. But we don't have time for that. But it's something that we will do with real cases. So the other idea is to really find a company and just discuss it for half a day, or maybe not one company, one or two, and decide whether to invest or not, and really invest in it. That's it.
Maybe it will take 3 months or something like that. Maybe
Yeah,
it's a
it will be not
process.
like one
Oh,
event.
yes.
Like first we gather,
Yeah.
then we start to do, when we write the term sheet, then
Yeah.
we write do the due diligence, and then we invest at the end of
Yeah,
it.
my idea, what I try to explain is also kind of around a real case study.
Yeah, it's for
BBC
sure a
practice.
good idea, and we should do this.
Hands-on.
We wanted to do this with the FINO, but we couldn't manage to find enough people, because that's what they're doing. In 3 to 6 months, they go through a use case, and then you can invest. It's a real example.
And first you meet with the founders?
Well, I think it's going to be online.
Okay,
But
but
we
somehow
can
to
actually,
meet
if we
them.
pick a Bulgarian company, because we were going to organize it online, but we can do it also offline. But if we're going to pick Bulgarian companies, so we can speak with them.
Yeah.
Yeah.
And start with this, speaking with the founders afterwards.
Yeah, we
to
can
our
do that.
insights
We can
and
do
what
that.
we think.
We can think about it. Yeah.
Yeah, I just wanted to thank you both for taking the time and organizing the event. It was really interesting. And I'm really looking very much forward to next sessions. I think it was just an appetizer.
Hey,
So-
it was, it was. But yeah, you should. I mean, I would tell this: the best way to learn it is to do it. Just be prepared to make the mistakes, but do it once. That's the way I actually learned this business, by diving in, rather than just to read about it and look from a distance, because you can really. I mean, it's also about entrepreneurship. You know, they say that entrepreneurship cannot be taught; it should be experienced. I think also that angel investing is similar. You can read, you can learn, but at the end of the day, you have to do it. And of course, decrease the risk by participating in a syndicate, investing a little bit of money, not a lot. But once you pay for it, how did I learn about Bitcoin? I bought some Bitcoins, and that's how I started to follow and to read about them, because when I was losing money, I was careful, and when I was making, I was bragging. Yeah. Okay, guys, thank you.
Thank you very much,
Thank you for your
Milen.
attention.
Nancy and his team for video recording the event. I would appreciate your feedback. I will send the Google form. I'll send the video recording maybe in a week. And thank you for being here. And I wish you a great day from here on. Thank you.
Thank you.